occurring.
All right, I'll wait for everybody to get on in here. A'udhu billahi minash shaitanir rajim. Bismillah. As we begin today, special shout out to the team. Amazing day today. Everybody get on in here first. We're going to talk about it. Let's talk about money. Let everybody get on in here. Let's talk about this. Exactly what we were talking about yesterday. Quiet souls in the building. Shout out to you, buddy. Grateful day. Grateful day indeed. Exactly what we talked about yesterday, QS, Quiet Soul. Exactly what we spoke about yesterday. Getting below that 674 and how dangerous it is. Yesterday's trade worked perfectly. 682 entry, 680 first profit target, 677.3 second profit target. Beautiful. And now we're looking at that third profit target potentially today. Let's go ahead, clean this up, and then put some plans together. Every day we come to the market with a set of plans for the bulls, a set of plans against the bears. We do not discriminate. We don't care who it is. We are looking for profits in the charts. Beautiful indication yesterday as we called that 683 strike, 682 with the entry, taking it all the way down to 677.3. And now that brings us to today. Explaining that domino effect and what that would have on the market. Let's see what today brings. Very interesting. We are now officially red for the month, and where we're standing at now, we're red for the year. What are we gonna do today? What are we gonna do today? What has already taken place this morning is a drop down to the 672. Clear support here. Looking for a bounce, probably to a lower high, probably a bounce back to the 677. For a bounce to the 677, and then make our way down. That's what I like to see. Based upon that understanding, probably like to see a call off of that 677 too. If we put in a lower high and she keeps going, potentially yes. So that's what I'm seeing so far. So for a call, we're going 676 on the strike, 677.2 on the entry, 681.4 for the first profit target. $683. $683.3 for that second profit target. And for a put, we're already here. Red for the year. We're already at the 672.5, which is where we're currently at right now. This 672.5 is where we're currently at right now. But like I said, I would definitely like to see a bounce back up to the 677.2 area. I would like to short the lower high. I don't want to short this out of the gate chasing this. I want to short the lower high. That's where the money and the momentum is going to be. Also, you still have to keep in fact that the bulls still have support here as well. So we can still expect some support here at that 699. That's 699. 669.8 area. 669.8. So we already know that where that's coming. 669.8. 669.8. How high could that bounce go is the question. I would like to get a bounce back to the 667, 677. If we can't, then at least I like to see us get a bounce back to the 673. So with that being the case, I'm going to say 674 put, 673.5 entry, 673.5 entry, very interesting. If we bounce to the 670, if we bounce back to the 673.6 area, and come down from that, let's just say 674, and come down from that, I'm looking at that 673.5 entry. We're definitely going to retest where we at now at the 672.5. We're definitely going to test 669. 669 3 area. And if she just snaps 6 6 8. Okay. That's what I see there. If we bounce higher, so I'm going to make two plans for the put. Again, I set up my monthly position here where I want to get in at 674, add at 671, go all the way to 666.2, possibly 664, because we are red for the month, also red for the year. So definitely going to reevaluate that. I want to come up with another set of plans for today for a put. Okay. My second set of put plans are going to come if we can get back to the 677. If we can get back to the 677, then I'd like to see a 678 strike, 677.1 on the entry, 673.6 on the first profit target, and then 670, 672. $672.5. Those are my plans right there. Let me clear this up, clean this up a little bit. Give me 1 second. We spoke about this yesterday, getting below that 674. And how dangerous getting below that 674 could be for the market. So I am looking for two puts here. I'm looking for a put potentially right here in this area. If we get back to that 677, I'd like to take a put here, right back, just like that. And if we get to just bounce back to the 674 area and then come back down, I'd like to see a potential break here, and we could possibly do that. Again, I know there's going to be support here at the 669.3 area. So, if we go to 674, I want to get in at 673.5. 673.5. Take that to 669.3. 668. That could really get you ugly because it's saying 666. The market is saying 666.3. Crazy. All right, and if we go to the bounce back to the 677, I want a 678 strike, 677.1 for the entry. 673.6 first profit target. 669.5 second profit target. All right, there we go. Two possibilities that could take place today, but both of them take place and begin with a bounce creating a lower high. We do not want to chase this out of the gate, as this could be a trap if we chase it out of the gate, because there is bullish support down at the 669, as we've seen in the past. And again, yesterday, as I circled and showed you how we would walk it down and find those people who had our profits once they got in a position where they needed to cover, exactly what would happen. Yesterday we did get down to that 677, that second profit target that was called out. We bounced, but we're right back to it. And once we came back to it pre-market, we broke it. These are my plans right here. Let me go ahead and see what they look like on the Thinkorswim platform. As of now, we are red for the month and red for the year, looking to short a higher low. So definitely looking for the bulls to get active this morning and give us the opportunity to short a higher low. When the market opens, this weekly chart will absolutely change. As this weekly chart is red. This weekly chart is red. Seems like we have really broken out of that algo. Today's daily chart is going to be very interesting. I'm going to go with this look on the 15, this look on the 30. Let's blow up the 5 to look at our game plan. Definitely looking for a bounce right out of the gate. call, 676 strike, 677 2 entry. Put an alarm there. Change that to a $678 entry. Alarm at 677.10, 678 entry. For a put, like to see a bounce back up here to the 674. So I'm going to put an alarm there because I'd like to see a bounce back to the 674. Okay. 674.5 is what I would like to see that bounce back to, and then see if we can break that and get involved at the 673.5 is what I have here. $677. If we bounce back to the 677, then I do like that. 677. Be very interesting. If we keep dropping here, I don't want to short this on this drop. I would like to see a bounce first and short a lower high. We are in a massive controlled selling algo that is extending from post-market and pre-market into the market open. There that is. There's a controlled selling algo on the screen right now. If anybody else have any plans they would like to share, please feel free to put them in the chat as I change my support and resistance lines appropriately. I just don't want to chase out the gate. I'm not going to chase. I'm not going to short below 672. I'm not. Trade based upon your understanding. I want to bounce back here to this 675. Okay, so I can get it coming back down or possibly back to the 677. But I'm not going to short this out of the gate. I'm not going to do it. It's Friday. We still want to look for obvious trades. We spoke about this yesterday, the importance of that 674 level. What happens underneath that 674? We are red for the year. Another reason why I don't want to short this right out of the gate is because there is bullish support at the 660, let's just say the 670 area. There's bullish support at the 670 area. We've seen them step back in at this area previously. So that's why I don't want to short into this area. I want to get a bounce up to the 677, short it coming back down, or bounce up to the 673 and short it coming back down. Possibly. That is what I would like to see. Again, the market doesn't care about what we want to see. The market is going to do what the market does, so we don't predict, we react. I'm still looking for clear setups. I'm still going by my rules. First 5 minutes, very volatile. First 15 minutes can trick you. I'm going to give the market some time. Both profit targets hit yesterday, the 680 and the 677.3. From that 677.3, we bounced. Yesterday we called out a 683 strike, 682 entry, 677.3 for a profit target. We told everybody it's get very, very scary if we get underneath 674, and we have done that right now. We're currently trading at 672.2. Very scary times. We're now red for the month, and we are red for the year. Only be looking for obvious trades. The market is coming out the gate. Shout out to those of you who have decided to trade early. It is there. It is there. So now, that's why I created 2 plans for a put. It doesn't look likely to get a bounce back to the 677. If we can get a bounce back to the 674, I would like that. Big shout out to the team in the building. Nkosi, Jared Lewis, Todd Macon, Quiet Soul. Yes, I'm going to wait until 10 and see what's going on then, Nkosi says. Very aggressive selling right out of the gate. But I just don't want to fall for that. Speaking about myself and my trading. Plenty of algos everywhere. The market is bloody red. I mean bloody red. Man, let's talk about money. Again, highlighting that monthly put that I told you guys Monday I was interested in taking. Getting into that 670.78. Strike 677. Oh, I'm sorry. That's not the monthly. Here it is right here. Monthly 676 strike. 674 entry, 671 add, 666 take one profit target, 664 second profit target. But again, that is because we are red for the month already. As for today, I'm remaining patient. I don't want to chase out of the gate. I would like to see us get a bounce and short a lower high. Again, my plans for today are very simple. If we don't get a lower high, I will not chase it. It's just that simple. Looking to see if we could bounce back to the 674, where I can then take advantage of getting in at 673.5 and bringing it back down to 669. That ain't right either. 669. No, I'm sorry. That's 671. 671.3 and then 669. 669.8. Okay. Again, looking for a bounce back to the 674 area. If so, I would like to come back in the market at the 673.5. area. Take it down to the 671. Say 672. And then 669. And you say 670. I'm changing it all here. Alrighty. Final change. 664 strike, 673.5 entry, 672 first profit target, 670 second profit target. That's if we get a bounce back towards that 674.5. I have an alarm at 674.5 to let me know that the market has made it back to that area. But right now, the market is not interested in bouncing whatsoever. The market is only interested in dropping. This is the area where I wanted to get in. As you can see, my arrow here, but I wanted to bounce higher and then catch it on the drop. So I'm just going to have to be patient, but the whole market is red, as you see right here. Tesla's red, Apple's red, Netflix is red, Nvidia is red, Meta is losing its complete ass. Down 20, the SPX is red, and the VIX is at 27. This is a disaster, but we saw it coming and have plans for it to make money, even as the market is declining. There's monies to be made. But I will be patient and wait for a bounce. Alarm set at the 674.5. Another alarm set at the 677 if we can get all the way up there. But for now, I'm just going to be patient. If you have any plans, feel free to put them in the chat. Anything on your mind, let me know. We can talk about it. Look forward to it. A lot going on right now. It's a lot going on. Again, you guys can also see now what is happening, why I did not want to chase that short out of the gate. I told the team I felt that could be a trap to chase that short out of the gate. Let's be patient, still institute our rules. First 5 minutes, very volatile. First 15 minutes can trick you. Give the market some time. The better trade is to short the lower high. If the market makes one. It definitely has to make one. We have identified 2 control selling algos, a larger one that has started taking place pre-market at 2:30 this morning. Let me show you that here on this 2-minute chart here. me change the color on this. What color can I change this to? Can I change? Let's change it to magenta. Let's change it to magenta. Okay. There is the larger controlled selling algo in magenta. So again, I'm looking for a bounce up to it, which is why I said that 677, because that will place us back at the top of this larger controlled selling algo. I would like to then short a lower high and take it on the way back down. Since market open, we have, since 8:30, we had a report come out at 8:30. We have created a second selling algo that I have identified here in purple. Looking to see if we could possibly break that as well and come back down. Either way, patience is required. We understand what we're looking for, what we're looking at. New 15-minute chart, new 15-minute chart. As yet, the market has turned another support area into clear resistance. Let's identify that now as well. Beautiful rejection as we remain patient. I just want to take a peekaboo to see what happens if I take off pre-market, just to see what that does to our lines. Yeah, it throws it off a little. Throws our lines off a little. Boy, the market is coming down, buddy. It's coming down. Again, I spoke to the team earlier this week about me taking a monthly position. For fear of getting underneath that 674. Profit targets on that are 666 and 664. 676 strike, 674 entry, 671.7 added, 666.2 first profit target, 664.5 second profit target for the larger monthly put. Again, monthly put. As of right now, we are red for the month. Is it sustainable? We do not know. No one does. What will happen today? No one knows. All we can do is prepare. So all we can do is prepare. Alarms are set. But again, my alarm is at 674 because I'm looking for a bounce back up to that area. You have to go all the way back, as I told you guys, and I showed you in the diagram that there was support here at the 669 area. Okay? Remember when I explained that to you earlier and showed you that there is support at that 669 area. I actually circled it on the trading view. I showed you the support here and that the potential that the bulls could come right back in the market in this same area. And that's why I did not want to short into it. I want to get a bounce from it to create a lower high. Chart looks a little crazy, but I had to extend it like this so you can go all the way back and look at Tuesday's low to see where that bullish support came right back in that took us to the 674 and then again the 677. The only thing that I'm looking for now is I'm looking for that bounce back up to that 674 and then looking to see if we could come back down. I wish I knew how to draw on these things. I'm gonna have to learn how to draw. Same thing. I'm looking for now for that bounce back up to that 674 like we did in the past. Okay. And then looking for that further move downward if the market gives it to us. Well, I've explained myself, I've explained my thoughts, I've explained my plans, I have my alarm set. Nothing else for me to talk about. Just be patient and wait. Again, highlighted this bounce area, bounce potential. But I'm going to put pre-market back up because I don't want you to get distracted, because really she's bouncing back to the top of this latest algo that was formed at 8:30. So in order for you to see that, I have to put pre-market back in here to make it make sense. And there it is. As I said, right now she's right back at the top of this purple algo that was created since the report we came out at 8:30. Looking to see if we can break it. Let's highlight that just a little bit, give it a little bit more respect. Okay, let's see if we can break it and fall back into the larger magenta selling algo and give us that lower high that I so desperately want. Let's talk about money. As always, as I've been doing this month, since I've been fasting this month, I have been relying a little bit more on CNBC to take up some of my slack for me after I thoroughly explain my position. Thank you everyone for your patience. Real big announcement coming next week. Please stick around. Real big announcement coming next week as we are approaching very rapidly the end of Ramadan, and I plan to start the course directly after that, as I will definitely have a lot more time and a lot more energy. Excited, man, because this course is going to take you from knowing nothing to placing your first trade with us. So for those of you who you have that are family members, cousins, nieces, nephews, even some children of your own, you want to embark this skill on them. I can definitely share this skill. I can't share the discipline, but I can share the skill. So I look forward to sharing this skill with all who want to learn it. It's going to be, as they say, freaking awesome. Clear bounce, clear rejection from the top of that purple algo. The bears are not having it. And that's why it was so important to identify both of these algos. We went right back to the top of it, right back to the 672. And that's all the bounce that we were getting out of that 672. That was the lower high that was created right out of the gate. But I'm going to continue to be patient and let it do what it does.
It's time for Jim and Stop Trading.
Yeah, Carl, I said to watch Marvell, which was up 8. Now it's up 12. And then I was noodling before this commercial. I should mention that Broadcom could fly here. Broadcom was up 30 cents. During the commercial, it jumped $2. So if you want to know what you want to follow, it's this semiconductor group, which is hot as a pistol despite the fact that the market is down. The Broadcom, by the way, is a $1.5 billion company. I just think that people have to recognize there are buyers of things, but they're buying things that are having a real run. I also want to point out that as much as I do like Benioff and I like McDermott, whatever, those stocks have had the run. The money might be going back. I mean, they can take profits.
Right.
The money might be going back into a Broadcom, going back into a Marvell, because the semiconductors have been very hot. Don't forget, right now we are seeing Samsung raising prices dramatically, and that cuts for Western Digital, it cuts for Seagate, and it cuts for SanDisk. So let's watch those two.
Yeah, we didn't really touch on defense names. We're going to have executives of the White House talking about production schedules and making sure these stockpiles stay elevated.
That's RTX, which was up 2.5 pre-market and is flat. I like that one very much, and everyone buys Lockheed. They always buy Lockheed.
Jim, we'll see you tonight.
Wow, yeah, this is tough. But yeah, I would say that one thing about Vlad is that some of those companies are interesting, and they're not just all companies that are aggregators of Amazon products, like toothpaste, which, by the way, a lot of them are.
Yes.
And that was really stupid that did that.
Yeah. Jim, we'll see you tonight. Mad Money, 6 p.m. Eastern Time, with S&P 67.15 and an almost 2% loss now on the Dow.
morning. Welcome to Squawk on the Street. I'm Sarah Eisen with Carl Quintanilla. We are live, as always, from Post 9 of the New York Stock Exchange. David Faber has the morning off. Stocks are under pressure this morning. The S&P down a little more than 1.5%. Every sector is lower in the S&P right now. Energy is holding up the best as oil prices surge. Financials are getting hit the hardest, along with materials and consumer discretionary. The Nasdaq's down 1.2%. WTI crude surging. We're talking about a gain of 9.3% right now. Brent crude, the international benchmark, it's above $90 a barrel. In fact, above 91 right now, up 7% on these risks coming out of the Middle East. We'll talk about it in just a moment. But just adding up the losses, it's been a tough week for the bulls. S&P now down 2% for the week. And treasuries, just show you what's happening there. Kind of a mixed picture. On the short end, they're rallying and you're seeing lower yields. Maybe that's the weaker jobs report. But on the long end, sell-off with higher yields, and maybe that's concerns about inflation. There's a lot going on right now. We'll talk about all of it this hour. Goldman Sachs chief economist Jan Hatzius with us. We'll hit the big jobs miss, the inflationary concerns around surging oil prices and the war in Iran. And then later, a cannot-miss interview with Fed Governor Stephen Miron just ahead of the blackout period before the Fed's March meeting. He will react to this morning's weaker jobs.
Let's get some more economic data this morning with Rick Santelli. Hey, Rick.
Hi, Carl. Indeed, this is December read on business inventory. So it's the final capstone on the year, and it comes in as expected, up 1/10. So we would have had back-to-back 1/10, except for last month, revised to unchanged. What I find interesting is that the high water mark was up 0.4, and that was in January of 25, which means next month when we get business inventories, we'll pay special attention because many significant adjustments during this tariff question, 3 basis points on the week. And Sarah, you're exactly right. We are basically unchanged to a little higher in price, a little lower in yield, only on a 2-year. But this is the first steepening I've seen in a while on the 10s to 2s spread, steepening today about 4 basis points. Sarah, back to you.
Okay, thank you, Rick Santelli. Let's just hit the jobs report this morning because it was a bummer, the headline. Down 92,000 jobs, so a negative number on the jobs print. The expectation was around 50,000 jobs. So we're not talking about high expectations of big job growth because of what we've seen in terms of a slowdown in jobs, but this one really went negative, and I think that was a big surprise to people, and it shows you where we've been over the last few months or so. It's been a sluggish environment for job creation. The unemployment rate goes up to 4.4%. And interestingly, the debate continues, Carl, about just how much of it is businesses not feeling in the mood to hire or just not enough supply of labor to hire because of the immigration crackdown and everything else going on. And the reason that debate rages on is because wages were really strong. They were up 0.4% average hourly earnings, and that was more than expected, 3.8% year on year, so better than expected, but also feeds into some concerns this morning around, and I hate this word, stagflation, right? Because job growth slowdown at the same time that you have inflationary pressure, the rising oil prices, big spike today, can't get away from that one, and then higher wages, and it makes you wonder where we're headed and what the Fed can do about it. Because typically the Fed would say, oh, we're not seeing job growth, let's cut rates. But not if they have to worry about inflation, too.
Yeah, that's a bit of a rock and a hard place. We've talked a lot about the degree to which the labor market is being supported by healthcare. And this shows you what happens when something goes wrong in healthcare, even if it's temporary, like a strike.
Right. So the silver lining of all of this is it could be some temporary factors that are weighing on the job market. And you mentioned the strike. Healthcare went negative, down 28,000 jobs. And there definitely was commentary in there that for instance, the strike there was the Kaiser Permanente strike, there was some medical strikes that put people out of work in this sector of economy. So when you're talking about strikes and weather and that sort of thing, you hope that it might be temporary. The other sort of negative in there was manufacturing, which we've been watching very closely, and we had seen some signs of life lately, but that went down 12,000. Construction was negative, which was a little odd because there's been so much construction of data centers. So overall, it wasn't a great number, and I think it doesn't necessarily match up with what we've seen from the rest of the economic reports. Yesterday, we did right here, we were talking about how ADP private sector jobs were strong, and layoffs continue to remain historically low. So overall, 1 month does not a trend make. let's see what happens. But it definitely will get the Fed's attention going into the next meeting, I think. Not enough to maybe change things on the pause. Feels like they want to pause, but I know someone who doesn't want to pause, and that's Stephen Myron. He's going to be talking to us next hour.
Yeah, although I'll be curious to hear from Myron whether or not he thinks we're still due for 150 bips this year, or maybe a little bit less, or maybe more. I don't know.
I think the biggest debate on the Fed right now is what is neutral. They don't know what neutral is. The level that the Fed makes policy where it doesn't hurt the economy and it doesn't help the economy. And there's some on there. Cleveland Fed President Beth Hammack says we're at neutral right now. And then there are others, the Doves, the Myrons and the Wallers, who say we've got some room to go to neutral. Why don't we just get to neutral so we can help the economy? So that, I think, is going to be the hot debate right now at the Fed.
Yeah. Meantime, let's talk more about the jobs number in the market today. David Kelly, Chief Global Strategist for JP Morgan Asset Management. David, good to see you again. Thanks for the help as always.
Sure, glad to be here.
Are you seeing clues about these long-standing structural fears about AI displacement in this print?
A little bit. We've seen some job losses in the information sector throughout the last year, so that there may be a tinge of AI on this. But I really think, to Sarah's point earlier on, I think a lot of this has to do with labor supply. I mean, if you look at both, because of revised data, now both surveys are basically lined up and looking more or less correct. And what they show is that over the last year, we only saw a 0.1% increase in payroll employment, and actually a small decline year over year in employment as measured by the household survey. So it really says we're not seeing any job growth at all really in this economy. But because immigration has done such a 180 here, and we've got a huge drop in the labor force, and that's keeping the unemployment rate from spiking here, but it's a very, very slow economy. I mean, I saw that the BLS said that employment edged down by 92,000 this morning. Well, that's a pretty sharp edge, and I think it's a pretty weak report.
Yeah, biggest decline in about 5 years. That's an edge. The other discussion, David, I guess revolves around NFPR and whether or not this participation rate is due to model changes or something more pernicious.
No, I think it's got to do with the immigration issue. When they took all those people out of the, when they adjusted the population numbers for a change in immigration, guess what? Most people who immigrate, over 70% of them, come in the working age population. Now, the overall population number they use for the labor force is actually age 16 to 120. But if you take out a lot of people who are in that working age group, the measured labor force participation rate goes down, and that's exactly what happened.
What about the spike in oil prices? I mean, how seriously should we consider how harmful that could be for consumers and for the economy? Because as I mentioned, past oil shocks and spikes, they're temporary.
Yes. And I think this one's temporary too. I mean, you can see it in the oil futures market. Yes, you're looking at that $88 a barrel, and that's pretty scary, but that's the April contract. If you look at the December contract right now, it's at about $69 a barrel. So the market's betting that this is temporary, but it doesn't help. And it doesn't help with consumer confidence because people are very attuned to the price of gasoline. And honestly, between the sort of tariff confusion and these now weak job numbers and oil, I think my biggest concern is this is going to further batter business confidence. And the problem is you just don't want businesses hesitating to make a decision. A no hire, no fire economy is no good. Because every week businesses normally hire 3 people for every person they fire, if you do the math. So this, it is a sluggish economy right now. The only silver lining, though, one silver lining, I do think the refund checks are going to pick up a lot over the next month, and that will help consumers out a bit and maybe help pull us out of this.
Yeah, there's been some work on tax season. Some argue that it's actually less about refunds and more about lower payments, David, but I want to set that aside. Are you a buyer of this notion that AI CapEx and the build-out is really masking what's happening in the real economy right now?
Yes, well, I think it's real. If it's your job, it's real also. So I think the CapEx spending will help construction spending overall, but other parts of commercial construction, offices, oil drilling up until very recently, they were all pretty weak. So it's a pretty soggy economy in other areas. So but you have to look at the economy as a whole, and and particularly when you've got low labor supply, it's a tortoise of an economy, but it doesn't look like it. I think we'll just dodge a recession unless something else hits us. We're kind of at the edge here. So I am a little concerned about this pileup of risks here. But overall, I think we will dodge recession, and there are parts of this market for which this will be seen as a buying opportunity.
I was going to say, so then would you put your money where your mouth is? Today, it's all the cyclical groups under pressure, the banks, the industrials, the consumer discretionary. Should you buy it? Should you hold your exposures? What should you do?
At least hold your exposures, and I think it's fine to get in, and also look at international, because we've seen a rally into the dollar. But as things calm down, I expect the dollar to flip the other way. I'd want to buy relatively inexpensive international equities too. So there are plenty of things to buy here if you regard this as temporary, and I do regard it essentially as being temporary.
Okay, David, thank you. David Kelly, really valuable to hear from you today. More private credit concerns are creeping up. BlackRock now limiting withdrawals from one of its funds. Our Leslie Picker has the latest, Leslie, and these headlines can be scary, but I think the details of what we get from these companies are important, and also so is the way that they're distinguishing them from each other. So tell us what we know.
You're spot on, Sarah. The nuance is really important because the headlines are scary, but what's actually happening is really important. In this case in particular, about half of the investors who wanted to redeem from a BlackRock private credit fund will be able to. This, according to a letter sent to investors in the HPS Corporate Lending Fund. In the first quarter, HLend received redemption requests totaling 9.3% of shares outstanding, and this is nearly double the 5% threshold that these vehicles set for redemptions. Therefore, instead of raising the cap or altering the capital return structure, as we've seen others do, BlackRock said that about 54% of investors' redemption requests were granted. That means if you wanted to pull out $100, you'd get 54. HLend says the 5% gates are a feature, not a bug, writing in the letter, quote, without it, there would be a structural mismatch between investor capital and the expected duration of the private credit loans in which HLend invests. HLend says it's generated 10.7% annualized return since inception and said that preserving the fund's capital, I thought this was really interesting, allows them to lean into compelling investment opportunities in the current environment. Now, this decision to thwart redemptions above the 5% level is different than what we saw Blackstone do earlier in the week. The firm's flagship private credit vehicle, BCRED, was also hit with a wave of redemptions, a record 7.9% there, but they decided to increase the limit to 7%, and then Blackstone employees and the firm's own capital covered the remaining 0.9%. When faced with a similar dilemma, Blue Owl changed the redemption limit for one of their private credit funds completely, opting instead to sell assets to return more capital to shareholders. So the whole publicly traded alt manager complex you can see declining today, down somewhere between 3 and 6% as these headlines continue to roil the publicly traded alts, guys.
What I've heard about the HPS one is that they've had more inflows than outflows, first of all. Which I think is also telling. Leslie, I guess the bigger picture here is what? People are spooked about the software exposure and they want out, and these funds are letting them do that just with different kind of strings?
Yeah, your point is a good one in terms of looking at net redemptions versus gross redemptions. But I think if we had a kind of lesson learned or a big takeaway from all of this is that when you do take retail money, which is largely what we're talking about here with these semi-liquid vehicles for private credit, they tend to be a little bit more jittery than institutional investors, especially when you see the slew of negative headlines that we've seen recently about certain loans being written down to zero. Can you trust the marks that you're getting in the communications that you have? Or the quality of the credit? Is it as good as it may seem? Retail investors start to question, their exposure. You see that in the publicly traded share prices of many of these alt managers, which have just absolutely plummeted year to date as the volatility continues. But the alt managers would say, hey, look, our default rates are still relatively mild. The software exposure is what it is, but as of right now, none of our software exposure is written down to zero. So there are definitely multiple schools of thought, but it's true that when the sentiment shifts, that affects the retail's appetite to stay in some of these semi-liquid vehicles, which is why you're seeing a surge of these redemption requests.
Yeah. The defaults are one thing, Leslie. Of course, the liquidity trend is another, which is important to watch. Meantime, on the IPO front, we had Vlad Tenev here at the desk earlier this morning. He was proud to be one of the, as he said, one of the few IPOs in sight at the moment. Universal Music Group reportedly pulling. What's happening to this notion that Q1 was going to be a some kind of IPO nirvana.
Yeah, I think that's all part of this volatility as well, Carl, is you see the alt managers and all of these portfolio companies, the sponsors were the ones that were supposed to spearhead a lot of the activity this year. And as they're grappling with their own portfolios, the recent sentiment around software, a lot of the portfolio companies have some sort of software exposure. It's become increasingly clear that it is the companies that are sitting in the private equity community that are very clearly not going to be disintermediated by AI. I think Bob's Furniture, which went public a week or two ago, those are the types of companies that are going to go out. But it's definitely created this reckoning of, okay, what is our story? Can we go on a roadshow, talk to investors, and will they buy that we're not going to be, that we're going to be around for decades to come?
Oh, we got one at the NASDAQ too. MiniMed went out, the spinoff of Medtronic, the diabetes company. So it's happening, just not in mass, as we might have expected. Thank you, Leslie. Leslie Picker. Here's our roadmap for you for the rest of the hour. After the break, much more on this spike in oil prices and reports of a big warning out of Qatar around $150 a barrel crude.
Goldman Sachs chief economist Jan Hatzius is with us with his first reaction to the jobs number. We'll talk about some of the internals and what they tell us.
And Broadcom's not the only AI chip winner of the week. We'll look at another name spiking this morning on, quote, robust AI demand. Squawk on the Street will be right back after a quick break. Don't go anywhere. Welcome back. Oil prices getting another major lift this morning after comments from Qatar's energy minister to the Financial Times. Brent now topping $90 a barrel, $91 a barrel. We're looking at the highest levels since 2024. Brian Sullivan joins us with more, Brian, and those warnings from Qatar about more, I guess, shutdowns on oil productions from the Gulf. What do we know at this point?
Well, we know that the Qatari foreign minister was telling the Financial Times that $150 oil is possible. They're not saying it will happen. They're saying that it is possible if we see more shutdowns. The Wall Street Journal reporting exclusively about an hour ago that Kuwait is looking to slow down production because they're simply running out of places to put it. Oil is like anything else. If you keep making it, but you have nowhere to take it or put it, you eventually run out of storage. And that's what's happening. Now, listen, Qatar, obviously, they are aligned with Iran. They actually share a natural gas field. So you could say maybe they're talking their book a little bit, but their point is well taken. I think, and I'd love to hear Jan Hatzius' view on this, because I know you guys have him coming up in a few minutes, that there's this idea, I won't call it a black swan because we obviously know what's going on. Maybe a black oil swan is a better term, because when you look at things like refined products, whether it's anything from chemical fertilizers, about 20 to 30% of which are also made in or around the Persian Gulf, things like jet fuel, or all the ingredients that go into gasoline. Gasoline is not just a barrel of oil refined. There's a lot of nasty chemicals that go into it. A lot of those things are made or shipped through Persian Gulf, Strait of Hormuz. Those are the things that we will likely hear about in coming days or weeks, depending, are starting to run out in specific places. And that is going to be the shock, and potentially, and again, ask Jan this, what the economic shock may be, probably starting with poorer nations first, but then trickling its way up. Oil prices up another 9% right now.
Yeah, and retail gas, Brian, I think 332 is AAA today. Higher than any point of either of the Trump presidencies. I do want to get you on Kuwait and help viewers understand what it means to shut a well, because that's kind of a big deal.
It's hard. I mean, it's not a faucet like at home. You have the water running, Carl, you turn the knob and it shuts off. I mean, it is a big deal to shut off oil and natural gas production. By the way, Qatar is offline because they, for a different reason, they got attacked by a drone or some sort of missile or projectile. That's 1/5 of global liquefied natural gas production that is currently offline. And by the way, natural gas is a major ingredient in things like plastics, roofing materials, etc. But to your point about shutting off production, it's not just hard to shut off, Carl, in some ways, it's harder to turn back on. Oil, it depends on the facility. You can turn it on and maybe in a couple days you start to get oil coming back out. But Qatar has warned that it's going to take, what, 2 to 4 weeks, once they turn the facility back on, to be able to not only produce natural gas, but then you have to freeze it. LNG is basically frozen natural gas. I think it's negative 179 degrees, something like that, whatever. Don't quote me on that. But it takes a couple weeks to get the facility to a point where you can refreeze the gas. So the knock-on effects of what we're looking at, guys, it's not like, okay, let's say Iran comes to the table tomorrow, or all the armed conflict, the war ends tomorrow, and suddenly on Sunday we start full steam again. Not how it's going to work. And this knock-on effect, and you're seeing some of the LNG stocks there because U.S. LNG is more valuable now around the world. Cheniere's up again, Venture Global down a bit. The knock-on effects, I don't think anybody, even as smart as Jan Hatzius and his whole team, are going to know exactly what they are. I don't.
Brian, what do we know about, is anything moving through the Strait of Hormuz, this incredibly vital point that carries oil from all of these countries every single day?
So there is one oil tanker company run by a Greek billionaire called Dynacom that has been turning off basically their tracking system, effectively, for lack of a better term, turning off the lights, turning off the headlights, and running the strait at night. Now, he's obviously putting his crew's life in danger. I mean, it's not just, we talk a lot about insurance and, oh, well, they cover the losses. 17 to 29 people on any of these ships, depending on the size, who are risking their lives to go into the strait. Guys, you both live in New York. I would say this. Imagine you live in New Jersey. You have to go to Manhattan through the Holland Tunnel or Lincoln Tunnel to get something, but you're not sure you can get out. So there's a lot of talk about naval escorts. Well, naval escorts are great, and I love the U.S. Navy. My dad was 11 years Navy, go Navy, but they don't do a lot about missile attacks. And also, if you get the ships out, are the ship owners willing to go back in, not knowing if they're able to get back out again? So there's a huge backlog, and you can bring up that live map again of ships that are sort of stuck there, trapped, kind of waiting to get out unless they're crazy enough or foolish enough to try to run through at night like we just talked about, Sarah. But I don't know if the ship owners are willing to go back in. And so you're seeing ships leave, and they're going around the world. And ship stocks have soared. You look at a Frontline or a Scorpio or a TK or some others, there's global stocks too. They're starting to fall today because you do wonder, they make a lot of money carrying stuff, but what if they run out of stuff to carry and they're just kind of floating around? it's a fluid situation that's changing literally by the hour, particularly by the day.
Yeah, and you're not even mentioning things like mines, which are another additional danger to those crews, Brian. We'll watch it closely. Appreciate it. We'll talk in a bit. Brian Sullivan watching the energy complex for us. He mentioned Jan Hatzius of Goldman Sachs, and we will talk with him about these inflation concerns around crude, plus today's jobs number and more.
Okay, team, this is what I wanted to see. I wanted to see us get that bounce, and that's why I said we were not going to chase. We're going to wait and get that bounce. Now, the most recent control selling algo right now has been neutralized. So with that being the case, we're going to go ahead and flip the script real quick. So I know when they come back on. I'm going to go ahead and flip the script. I'm going to lighten this up. This purple algo. I'm going to put it in the background because the magenta is now front and center. And this is what I was looking for that bounce back into this magenta. Shout out Eric for teaching me this. Thank you so much. Now, this is also what I was looking for. I told you that bounce back to that 674 area. And then I would like to come on in at 673, take it down to 672, and then 670. This is what I was looking for, guys. This bounce back to this area. My alarm is at 674. 5 went right up to it. Again, nothing is exact in the market. Everything is probabilities. But now we want to see a very strong bearish signal, an engulfing candle, a shooting star, a evening star. We want to see a very clear reversal signal pattern before we get into this to come potentially to come back down. There's still a little more room she could go to the top of the algo, but she could very well come on back down now, giving us that lower high that we were looking for to short into potentially. Hope everybody understands. Again, this is what I was looking for in that diagram. I wanted to see that bounce back up to that 674, okay? And then we'll catch it on the way back down. There's also another potential move back to that 677. But now we're looking for a very clear setup at this potential 674 rejection. Less than 30 seconds, we're going to have
We
a
are
new
about 30 minutes here into the
candle.
hour. Here are three big movers we're
A
watching.
new
Chipmaker
30-minute candle.
Marvell
Just wanted to
jumping
point
this
that out to the
morning
team.
after strong quarterly results boosted by AI demand. The company CEO saying he expects year-over-year revenue growth to accelerate each quarter in fiscal year 2027, driven by the data center business. Meantime, Gap shares are moving lower after earnings narrowly missed estimates. The company says comp sales were hit in part by severe winter weather, which led to temporary closure of 800 stores. And then airlines are also under pressure today as those oil prices climb. United CEO Scott Kirby said
There we go.
that the spike in prices will have a quote.
Now we
meaningful
want to
impact
look for
on
that
financial
rejection.
results
Now we want to
this
look
quarter.
potentially
Big
for
consumers,
an
obviously,
entry.
and they pay those higher bills, even
Yeah.
if it is temporary.
Also trying to charter some planes to get Americans out of the region, which is another issue.
Big story, too, yeah.
Let's get a CNBC News update with Dom Chu. Morning, Dom.
Good morning, Carl. Good morning, Sarah. Russia has reportedly given Iran targeting information and intelligence to attack U.S. forces in the Middle East. The Washington Post reports that since the war began last Saturday, Russia has passed on the information and location of U.S. military assets to Tehran, including warships and aircraft. Neither the White House or Kremlin has commented on that report. Facing an ethics probe and a call from his own GOP leadership to leave the race, Texas Congressman Tony Gonzalez dropped out of his runoff election. Earlier this week, he admitted having an affair with a former staffer who later killed herself. While Gonzalez won't seek re-election, he says he will serve out the remainder of his current term. And Ukraine today accused Hungary of taking Ukrainians hostage and seizing millions in cash. Hungarian authorities detained 7 Ukrainian citizens, including a former intelligence officer, on suspicion of money laundering. They were carrying large amounts of cash across Hungary in 2 armored vehicles. Ukraine's foreign minister saying the armored cars were part of regular services transferring money between Austrian and Ukrainian state banks. Hungarian President Viktor Orban has maintained close ties with Moscow throughout the course of the Ukraine-Russia war. Sarah, I'll send things back over to you.
Okay, Dom, thanks. After the break, Goldman Sachs chief economist Jan Hatzius will break down the surprise miss in this morning's jobs report and another twist in the Anthropic story, why the company CEO says it's taking the government to court. You'll hear all about his latest apology when we come right back.
Okay, team, this is exactly what we were looking for. A bounce up to this area, the 674.5. Now let's see. The market has my attention, doesn't have my money yet. Now let's see if we have a very strong reversal signal or if we keep going to the 677. We'll love to see us go to the 677. A bigger bounce could potentially mean a bigger fall. But if all we get is this 674, that 673 is now available to trade in with a clear reversal signal down. Without that clear reversal signal, she could go to 677, which is why I made plans for both this area and plans for the 677 area as well. Just to refresh your memory, we can get up to that 674, which we did. I like to catch it coming back down at 673.5 all the way to 670. If we go to 677, okay, love to do a 678 strike, 677 entry, and take that back down to 672. Done a great job remaining patient. Now let's look for the obvious trade.
We are 1 hour into the trading day. Stocks are under some pressure, but they are off their worst levels. The Dow was down 945 points at the lows. Some of the big stories we're watching this morning. That February jobs number widely missed expectations, a loss of 92K versus estimates of a gain of about 50. Unemployment rate did go up a tick to 4.4. Oil prices up after the FT cites Qatar's energy minister saying that oil could potentially climb to $150 a barrel if conditions don't change in the Middle East. And some more private private credit concerns today. BlackRock puts limits on some withdrawals from one of its flagship funds. Financials today, one of the worst sectors, down almost 10% for the year so far.
Yeah, another mix of bad headlines for that group. Sticking with the jobs report, here's what NEC Director Kevin Hassett from the White House said last hour about it here on CNBC.
There have been so many strong indicators this month that it's something of a surprise, but there's some weather, there are strikes on the West Coast, and I think that we also have this birth-death model, the change in the procedure at the BLS. And so I think what we need to start doing with these jobs numbers, at least on the payroll side, is take the average over a few months. And if you take the average over a few months, we had a surprisingly positive one last month and a surprisingly negative one this one. But on average, it's about what we expect to be seeing.
Let's bring in Jan Hatzius, chief economist at Goldman Sachs. Is he right to dismiss this weaker jobs report? Strikes, weather, one-offs?
Well, it's certainly true that strikes subtracted, 30-something K, and the weather, I do think, had an impact. I also agree that we should take an average. These numbers are always, noisy on a month-to-month perspective. If I do take an average, though, it's still a pretty weak labor market with very little job growth and zero job growth, or negative job growth if you take out healthcare, which is pretty narrow base. So while there is a lot of strength in the underlying growth picture and the productivity picture, we're now dealing with two issues. One is that the labor market translation of the growth picture has been pretty weak, and now, of course, we're getting an energy price shock, which is unfolding. So we're going to have to see how big it is. At the moment, the numbers that we're getting out of translating current oil prices into headline inflation boosts and growth drags are not that big, but obviously it's a very fluid situation.
So is stagflation the right word to use, or no?
Directionally, that's where, of course, the recent shocks have been going. It's always, a word that people use easily. I don't think we're in a stagflationary environment yet, but yeah, the shocks have been pointing that way.
I'm thinking back to last spring, Liberation Day, tariff turmoil. You were, I think, relatively quick to move the dial on your recession risk. Is that in the mix now or no?
Well, I think directionally it probably is going in that direction. I mean, we came into the year with a 30% recession risk estimate for the next 12 months. We lowered it after the better employment numbers that we got in early January, and directionally it's obviously going higher at this point.
So do you think the lack of job growth is because of the immigration policy?
Well, I think the slowdown in labor force growth because of immigration policy has been one reason why the weakness in job growth hasn't translated into as much of an increase in the unemployment rate. That, I think, is certainly true. We would have seen a significantly bigger increase in the unemployment rate if, break-even payrolls were still 100,000 plus, but break-even payrolls are, 50,000 or less. So that's obviously an important factor.
And what explains claims? Why are they still so tame? Is there a good theory behind that?
Because I think we're still in a low hire, low fire environment. So, job openings are still trending down. And the latest JOLTS number, of course, was quite soft. But we have seen not really much of an increase in layoffs. So that is good news in the sense that it doesn't look like anything's breaking from the layoff side, but obviously that's something that we're going to be watching very closely.
We're also seeing decent wage growth. I mean, today's number, 0.4% increase on average hourly earnings, does not speak to a very weak labor market where businesses are pulling back. How do you explain that?
Well, I think monthly wage numbers are noisy. The trend in wage growth has been lower for the last several years. I don't think that has changed. We've come down to the kind of 3.5%, 3.75% range. If I look at all of the different indicators, the latest employment cost index for Q4 was actually a little bit softer than that. I don't think that trend has changed.
So ultimately, what should the Fed do about this?
Well, I think what they are likely to do is, watch and wait. There are obviously significant divisions in the committee where some are very concerned about the labor market, some are very concerned about inflation higher. And so for now, I think they're not likely to do much. And for the time being, that seems like a reasonable...
Which should they be more concerned about? Which do you think is the bigger problem for the economy?
I think the more like... I think probably the labor market numbers are the bigger risk, which is one reason why we still have some cuts in June and September. We haven't made changes to that, as we think that core inflation is likely to come down, especially in the second half. But I do worry about the fragility in the labor market.
Finally, on areas in which consumption is vulnerable, would it be a cracking of the capex, the build-out cycle, or maybe something regarding the wealth effect and upper income, or something else?
Wealth effect is certainly something to watch, just because we have seen so much support from the wealth effect to consumption. But the number one thing for me now is what is going on in the labor market. If we were to see more of a deterioration there, that I think is still going to have a broader impact. But yeah, I mean, wealth effects can obviously turn from positive to negative, and so that's something to watch as well. We did put that high up on our list of risks.
I saw that.
At 10% pullback, we said 10% pullback in equity prices is worth about 50 basis points on growth. Obviously not on a immediate basis. It has to be sustained, but it's definitely something to watch.
Is there a level, like if we get into the hundreds in terms of oil prices, or a duration of how long this lasts, where you have to go back and rethink the economic forecast?
No, it's a combination of level and duration. I mean, if you get each 10% increase in oil prices, we think probably adds a couple of tenths to headline inflation and takes off a tenth or so from growth. But it could also become more nonlinear if we were to see bigger increases. We're not there. The increases that we've seen so far, still have a digestible or manageable impact on the economy. But obviously, if we were north of $100, then that would be a different story and would call for a reassessment.
Okay, really helpful to have you here today, Jan. Thank you very much.
Thank you very much.
As always, Jan Hatzius, chief economist at Goldman Sachs. Sticking with the macro for a moment, today is a major milestone for former Fed chairman Alan Greenspan. It is his 100th birthday. Happy birthday, Alan Greenspan. He served as Fed chair from 1987 to 2006. We were just talking about it, 5 terms, unbelievable. Nominated, of course, by President Ronald Reagan. And I think that one reason he's celebrated as the maestro, Carl, is under his tenure, the U.S. economy had one of its longest, most unprecedented, uninterrupted expansions in history, where the market was higher for several years between 87 and 2006. And, he finished the job of Volcker, moderating inflation, got us through the crash of 1987 and sort of other major points. And so he's considered a legend. Happy birthday.
Yeah, I mean, I'm just thinking back to things that he helped us get through. I mean, right? Fall of the Berlin Wall and the end of the Cold War and a bunch of other nice tailwinds that it would have been good to have as Fed chair.
Absolutely. And we were just talking to Jan Hatzius about how he always said he wanted to live till 100, and so he got to do it.
Yes.
So we wish him a happy birthday and many more years of good health.
Yes. Still ahead, speaking of Fed officials, Governor Meyer will be with us at Post 9. We'll get some reaction to the jobs number, his read on inflation, and a lot more. Dario Amodei taking on the Pentagon after Anthropic was formally declared that supply chain risk. We'll break down the fallout from that when we come right back.
Welcome back. More drama around Anthropic today. The AI company saying it will challenge the U.S. government's move to declare the firm a supply chain risk. Kate Rooney joins us with the details, Kate. So we have this post by Dario, the CEO, where he kind of apologizes, and then he does this interview. I'm not sure how it's all going to go down in the Department of War. What do you think?
Yeah, Sarah, it's been playing out in drips, and so far until yesterday, it had really mostly played out on social media, but the Pentagon formally notified Anthropic yesterday that the AI company and its products are now officially a supply chain risk. This is the first for an American tech company. So the only other examples have been those accused of espionage for foreign adversaries. Think of Huawei, ZTE, Kaspersky, for example. The CEO of Anthropic, though, saying in that statement last night that they have no choice but to now fight in court. The move, he says, is not legally sound. He also did apologize for a leaked memo to employees in which he criticized rival Sam Altman at OpenAI for what he called dictator-style praise of President Trump. But back to the supply chain point for a second, he does point out the scope here is narrow. So that's because of a relevant statute that they use, and what has been applied here, he says, is meant to protect the U.S. government rather than punish a supplier. So this applies to specific government contracts, not the rest of its sprawling enterprise business, which really had been a major fear for investors who worried about any sort of chilling effect on its sprawling enterprise business. Last I heard, the company was on track for roughly $19 billion in revenue this year in terms of the run rate. Microsoft, though, backing up Anthropic last night, the tech company, major investor in Anthropic, about a $5 billion stake it took last year, and then said that its lawyers determined Anthropic products can remain available to customers outside of the DoD. So Satya Nadella's move, though, it's important to calm some of those concerns from other enterprise companies and partners, help kind of contain the fallout here, and make sure that these AI models stay widely available. That is hugely important to the company. We have not heard from other major partners, but you got Amazon, which has invested $8 billion in Anthropic and uses its tools across AWS and e-commerce. Anthropic also uses AWS and Google Cloud as its primary infrastructure partners, guys.
I asked Mark Benioff about this because they're also a partner and also a big investor in Anthropic. Yeah. I said, did he make a mistake? Did Dario make a mistake not acquiescing to the Pentagon? He said, I'm not going to, they have to make their own decisions. He didn't really want to go there. But I was just reading the blog post, Kate. You said he apologized. He apologized for the post getting leaked to the press, basically. He said, I want to apologize directly for a post internal to the company that was leaked to the press yesterday. We did not leak the post or direct anyone else to do so, not in our interest to escalate this situation. He did not apologize for, calling President Trump a dictator or going after OpenAI or anything like that. I just don't think it's going to go down well at the Department of War, and this is only going to escalate for them.
You've already heard. That's an interesting point. He didn't apologize. He apologized that they heard about it. But no, it's a great point. He also, the blowback from the administration, I think, is going to be hard to contain at this point. You heard Emil Michael call Dario Amodei a liar with a God complex. It has gotten to a point that it's going to be hard for them to come back from sort of the headline risk and the animosity between the administration. One saving grace would be if they're able to contain this, though. If it's not going to be across all of their enterprise businesses, it's just government contracts. There is another side of Silicon Valley that is rallying behind Dario Amodei. It's just become very divisive and political. So it kind of depends on which side you're on and which side you're sort of rooting for in this what is now just a battle in tech right now.
Yeah, it's actually going to make a great business ethics case study one day, because on the one hand, you're allowed to have corporate principles and even disagree with the government. On the other hand, what is your fiduciary duty about those revenues in that line of business if it's going to put your company in some incremental peril? Really fascinating. Kate, thank you. Kate Rooney.
Great point.
Yeah. Still to come, the world's richest once rushed to Dubai. Now they're trying to get out. We're going to look at what the future may hold for that region and all the Gulf states in a minute.
Trend Tracker is sponsored by CME Group. CME Group, where risk meets opportunity.
The world's rich once rushed to Dubai, but now they're rushing to leave. Our Robert Frank joins us here at Post 9 this morning with that story. It's incredible. Actually, it's not an easy story to read for the rich or the unrich.
Yeah, really, this war kind of possibly redrawing the whole map of wealth right now, because wealthy residents of Dubai scrambling this week to book private jets and charters out of Oman or Saudi. That's the only airports they can really get out of. A private jet now there costing you about $250,000 just to leave. Now, this wealth flight marks a big turnaround for an emirate that until this week led the world in actually attracting millionaires. So last year, nearly 10,000 of the world's millionaires moved to Dubai, bringing along about $63 billion in wealth. Dubai offered the three things that the wealthy want most: sun, safety, and tax-free income. Dubai real estate has been growing for 5 years straight, first from the pandemic, then you had a lot of wealthy Russians moving in, and then the wealthy from the UK, China, India, Europe, other parts of Asia. Now, over the past week, drone strikes or collateral hit 2 luxury hotels in Dubai, along with the airport and a location near the U.S. consulate. The UAE government saying last Saturday, quote, the situation is under control. The Dubai police this week threatening to arrest or jail any influencer who posts social content contradicting the government or deemed to create panic. Now, immigration advisors saying the vast majority of wealthy Dubai residents, they're staying. And Dubai's main attractions have not changed. But today's wealthy, they want geographic diversification, both for their money and their families across the Americas, Europe, and Asia. So lawyers say some who are now in Dubai may be looking at Singapore and New Zealand. For the full story and how the Iran war could redraw the global wealth map, you can sign up for Inside Wealth at cnbc.com/Inside Wealth.
I feel like short-term problem, long-term should be very bullish for places like Dubai or Saudi or Oman having, I don't know, a terrorist state right in the middle of them being neutralized. Wouldn't that be really ultimately very good for their tourism and for their growth?
That's the hope, although they have done well creating pillars of stability with Iran where it is because they've been neutral. But you're right, long term this could be positive.
Could be even better.
That's right.
Let's hope. All right, thank you, Robert. Robert Frank. Still to come, Fed Governor Stephen Myron joins us. His first reaction to the jobs report. Money Movers starts after a quick break. Good Friday morning again. Welcome to Money Movers. I'm Sarah Eisen with Carl Quintanilla live from Post 9 of the New York Stock Exchange. Today, we are joined by Fed Governor Stephen Miron to discuss the macro impact of the Iran war, inflation expectations, and the current oil price shock and outlook for the Fed's next rate decision.
We're watching tech today, the sector under some pressure for the year, but the vice chair of Citizens Commercial Bank is with us to talk about why he thinks this so-called death of software is greatly exaggerated.
And the AI jobs impact. Anthropic says it's building an early warning system for potential AI-driven white-collar jobs destruction. We'll explain.
As for the markets, yet another day, like Tuesday, like yesterday, where we open lower, get a bid right around 10:30. We're off the session lows here. We were down about 1,000 points on the Dow. S&P got to 67.15 or so. All Dow stocks at one point were red, but now we got green on Boeing, Salesforce, Microsoft, Walmart. Then, of course, the 10-year has been kind of refusing to leave the neighborhood of 415 the last couple days.
It's been a tough week overall for stocks, but there has been a bit of a pattern of buying from the worst points of the session, right? A little bit more. We end up in a little better place than we began, certainly with the market and with this worry about high oil prices and higher bond yields. Energy, as you just said, has popped up.
Yeah, interesting that there's a little equity buying, even though oil hasn't really come down from the session highs. Let's begin with the energy markets this morning and some international officials now saying there's the possibility of crude rising to, say, 150. Our Pippa Stevens is with us this morning. Hey, Pippa.
Good morning, Carl. So Qatar's energy minister telling the FT that all Gulf exporters could shut down production within days, and that would send oil to $150 per barrel. Brent topping 90 on the back of those comments, hitting the highest since April 2024, with U.S. crude within striking distance of 90 as well. Iraq has already shut in some production because there is nowhere for the oil to go. Tankers in the Persian Gulf are quickly filling up, and new ones can't enter to be loaded with oil, with onshore storage tanks also quickly filling. JP Morgan saying today the market is, quote, shifting from pricing pure geopolitical risk to grappling with tangible operational disruption, or as Citi put it, when a wild card becomes the reality. There's now $17 billion worth of crude, products, and LNG cargoes trapped inside the Persian Gulf, according to Kepler, and product markets are getting tighter. Gasoline futures at a nearly 2-year high as the price at the pump hits $3.32 per gallon, with European diesel tracking for its largest weekly rise on record. TTF gas at $52.30. That is more than 5 times higher than Henry Hub in the U.S. Guys?
Pippa, really quickly on retail gas, as we watch wholesale, somewhere in the 270 range, would that imply retail getting closer to $4 than $3?
It certainly seems that that's the way things are going, Carl. And if prices got up to 150 on Brent, we could see prices at the pump hit 550. That, of course, is a tail end, very much a tail end risk at this event at this point. But also prices are rising very quickly because there was a little bit of lag in the wholesale trickling through to the prices at the pump even before the events of this weekend transpired. And so it certainly seems that gasoline will be following Brent prices higher. And also, we are starting to now come into the spring and summer driving season. So no doubt this is going to be a weigh on consumers.
Okay, thank you, Pippa. Pippa Stevens. For more on how the market's digesting both the Iran conflict and the weaker jobs report, let's bring in Rosenberg Research founder David Rosenberg. Because we're talking about oil, David, I've cited your study that you did this week and your research showing every time we've had a big oil spike, a year later, it's worn off. Is that how you're feeling about this one, too?
I am actually, because, when you think about it, we were at $120 on WTI in the winter and spring of 2022. I wonder if many people remember that. That came off the Russian invasion of Ukraine, and oil peaked and came right back down again. Nobody talks about it today. We persevered. When we had, Operation Desert Shield and Desert Storm, and I wonder how many of your viewers remember that. It was a long time ago. That was Iraq War I. The oil price doubled. And so, doubling this time would take it to $120. It's really a question as to, how long it's going to stay there. There's no question that it's not just the move, but the rapidity of the move. Back in 1990-91, look, we did have a mild recession, and we persevered, and nobody talks about it today. So, To everybody who's watching, I say this too shall pass.
Yeah, but it could
is
cause
definitely
pain in the short term, right? I mean,
Yes,
this is short-term pain at the pump, a vulnerable consumer already suffering at the low end, midterm election year, you know, there could be some damage.
Well, I don't know how the midterm election year is going to play out from an economic standpoint, but this is clearly a disruption. Now it's a really good thing. We're going to get those income tax refunds because the consumer sector is going to need it just to stay intact, not to go on vacations or buy luxury goods and services. But look, the quicker this war ends, in my view, although I'm not a geopolitical expert, but I am an observer, if this lasts weeks, as the experts say, and not months, then we won't be talking about this in 3 or 4 months' time. So yeah, if you're trading the market as opposed to investing, or you have a very myopic near-term view, of course, this is nail-biting time. But the one thing that we always know about these geopolitically induced oil price spasms is that they don't typically have any staying power, because what ends up happening is it squeezes real incomes and purchasing power, and that demand destruction ends up sowing the seeds of the demise for that oil price increase. And that's why we know from the history of oil prices, it looks like a sine wave over time.
Right. Meantime, David, I mean, we continue to get reminded this week about the lower energy intensity of not just our economy, but the global economy since 1990. That holds, yes?
Absolutely. Well, it is more of a service-driven economy. That much is true. You don't want to totally, underplay the impact this has when people go to the pumps and they pay those higher retail gas prices or the diesel fuel for truckers. So just to say, well, it's not going to have as big an impact that it would have had in the 1970s or 80s or even 90s. And in the 90s, we really became a really super duper more service-oriented economy. The reality is that the service sector ultimately services the goods sector. So you can't dismiss the economic implications, but I'd agree with you, Carl, that the situation would be a lot more dire economically 20, 30, or 40 years ago.
Meanwhile, on the jobs number today, David, I love this number you just put out, that if it hadn't been for the decline in labor participation, unemployment would have gone to 5.1. Is that true?
Yeah, the participation rate has come down. I don't think this can only be due to what's happening on the immigration side, because that really hasn't influenced glacially. But we've had a precipitous decline in the participation rate just since November, and all I did was just a arithmetic exercise that had the part rate stayed the same, the unemployment rate would be over 5% right now. But the reality is that the proof of the pudding's in the eating. We are not seeing a breakout in wage growth. Nominal wages are not breaking out. And if you have this view that this is more a supply tightness labor market, it's not really a reflection of demand, well, then you'd be seeing this 4% plus unemployment rate triggering a revival in nominal wage growth. And nominal wage growth is running, what's it running year over year, Carl? 3.8% at a time when productivity is running 2.8%. And that's why unit labor costs, really the mother's milk for labor cost inflation, coming from any sort of a job market, is unit labor costs. It's running at 1.3% year over year. It's half what it was this time last year. And that's why, by the way, I don't have a very pernicious inflation view, because when I look at the situation, we don't have monetary inflation, we don't have labor cost inflation, we have commodity inflation, but we know that doesn't have the same lasting power that money supply growth does and what the labor market delivers. So I think this basically cost shock that we're seeing, whether it's shipping costs or energy into other raw materials, that's going to hit a wall in the labor market and just cause real incomes to decline. And then we'll see what inflation looks like when that starts to happen.
I guess, David, the pushback on the weaker labor demand story is really what's happening with jobless claims, which they're still historically low. And other evidence of layoffs as well. We just aren't seeing them if you were really worried about a sort of recessionary type job slowdown.
Well, You're right about the claims numbers remaining very benign. And when you go to the JOLTS data, you'll see the firing rate is very benign. But what's happening is the hiring rate and the job opening rate, the true measures of labor demand, are falling precipitously. And one of the reasons why you're not seeing a big decline, a big increase in firings is why would a business fire their existing workforce? I mean, we had a situation, for example, let's take all of last year, Sarah, and we had 3%, we had 3% growth in real non-farm business output, and we had 2.8% productivity growth. So what does that mean? It means 93% of the output that the private sector is generating is coming from the productivity of their existing workforce. Well, why would you fire those workers? They're doing all the, they're meeting all the order books, they're meeting all the production schedules, but it comes down to what does it mean for new employment creation? Because you're not getting any hirings. So I would tend to agree with you that, you know, we don't have a firing cycle, we don't have a hiring cycle, and a stagnant, if you don't want to call it a contraction, and it's maybe not a contraction if you look on a year-over-year basis, employment, whether it's the household survey or the payroll survey, employment is running at 0% growth, Sarah. So maybe that's the Fed's new definition of labor market stability is no growth. Is that really a sustainable economic model? Now the economy is growing because we have a productivity boom going on. But this is to the detriment. I mean, look what's happening to job opportunities for college grads, for example. Look at the younger cohorts. They're under significant strain because they're not finding a new job, right? And that's why, for example, you talked about the jobless claims, but you saw this past week, the continuing claims data hooked up a lot. And that's telling you that people are having a lot of difficulty finding a new job. So to then say, oh, this is like a healthy labor market, or, oh, this is basically what the Fed calls labor market stability. No, this is actually a sclerotic labor market we have in our hands. No higher labor market, that is not a good thing. It's a good thing if you're an existing worker and you're productive and your job is safe. But for everybody coming into the labor market, your job opportunities are few and far between. That's the point that I'd be making.
Yeah, well, it's a depressing one. David, thank you for joining us on the analysis,
okay.
As always.
Thanks for having me on. Have a great weekend.
You too, David Rosenberg of Rosenberg Research.
When we come back, what results from chipmaker Marvell Technology signal about AI demand? Stock is surging in a challenging tape this morning. Plus, our next guest arguing the death of software is greatly exaggerated. He joins us after the break with some names in which he sees opportunity.
Then don't miss Fed Governor Stephen Miron. His last public comments ahead of the Fed's March meeting. Blackout period starts. How the jobs report is influencing the outlook for Fed policy. Money Movers, back in a moment.
Welcome back. Results from Marvell, the latest indicator of AI demand. Our Christina Partsinevelos has more read-through from those earnings. Holding up here, KP.
Oh, definitely holding up, but there's a reason. I'll explain. So Marvell management showing that AI infrastructure spending isn't slowing down by doing something companies almost never do in quarterly earnings calls. They guide 2 years out on fiscal 2028 revenue and earnings. That kind of visibility is quite rare. JP Morgan calling it, quote, a strong multi-year revenue outlook. UBS said the results came, quote, against a high dose of skepticism. And heading into this print, there definitely was plenty of that. Shares were only up about 3% year to date, underperforming the SMH into the print. It's also the second big data point in just 2 days. Broadcom reported Wednesday night that AI chip revenue more than doubled, with a guide of over $100 billion in AI chip sales by 2027. Two very different companies, but the same message. The hyperscalers are still spending. And that matters because the market has been asking whether Amazon, Microsoft, Google are just overspending on AI with no clear payoff. Two prints like this in 2 days kind of make the argument harder to sustain. Marvell's CEO Matt Murphy said it plainly on the call. Quote, look at our results that we're guiding. Look at our outlook for this year. Look at our outlook for next year. Do you see me blinking? You don't. Not exactly the words of someone worried about peak CapEx. Today's stock pop, though, isn't purely fundamental. Traders are also positioning ahead of a potential S&P 500 inclusion announcement expected after today's close. So index investors buy in anticipation of forced demand and shorts covering to avoid a squeeze. So that is why you're seeing shares up 18%, a lot more than expected.
And just remind us where Marvell plays against some of its semi-competition when it comes to building out AI.
So a big portion of Marvell's business is, of course, the custom chips. Amazon is a big partner. So on the call, they did speak about how their training and development is underway. There's been no issues. The other part is connectivity. So Marvell also works on how a lot of data centers talk to each other and then how chips talk to each other within the data center. So that business, the peripheral of the AI infrastructure build-out, is growing. And it's not all about chips anymore. It's how these chips talk to each other. It's routers, it's the copper cables or the optical cables. And so that is where Marvell also plays a big role.
Christina, thanks. Important news in the chip space today. Christina Partsinevelos on Marvell. Let's turn to some software. The sector is making a comeback this week, as you know, although the IGV is still down more than 15% this year. Joining us this morning, Citizens Commercial Bank Vice Chair Mark Lehman's with us. Talk about maybe a shift in sentiment going on, Mark. It's been a wild swing, but there's been some repairing in the last few days.
Yeah, Carl, thank you for having me on. It has definitely been a wild swing. It's definitely been a sector that's been recovering a little bit, but obviously after some really horrific news and some horrific fears that have been stoked by a lot of people.
What gives you some faith that this is not an existential threat for software overall?
Well, I have some faith that there'll be winners here. I'm not sure it is not an existential threat to a lot of companies who can adapt and adopt. I've watched this several times in my career, whether it's the move to the cloud, whether it was the move to on-prem, all the things that we've seen. And the winners just get much stronger, and some of the people who are not able to adapt go away. And I think that will be the case here. I also really like the energy around some of these CEOs who are really in for the fight. Some people who have made a lot of money and have watched stocks go up a great deal in the last 20 years. People like Mark Benioff and Anil Boozary, and we had ServiceNow at our conference, the Citizens Tech Conference here in San Francisco this week, watching the kind of the anger, the denial anger curve. They're ready to fight, and there are going to be some big winners here, but it's going to be a really interesting fight for the next 5 to 10 years.
I think there's two issues when it comes to the software concerns that I hear, Mark. It's the existential ones, which I think you just addressed, and what I think has fired up so many of these CEOs and these companies. But then there's also just the erosion of pricing power and moats and questions about what to pay for those businesses in this new reality, which may be more what the market is actually factoring in here.
Sarah, I think you're right. I think the question is, we're in this phase, and the market does not like question marks. They like a surety. And for years with the move to the cloud and seat licenses, you were really assured of where that revenue growth was and what next year looked like well in advance of where you were in the current year. Markets love that. This newfound fear is exactly that. That being said, these companies are getting wildly more efficient with AI, the pricing power that they'll have with that, whether it's per seat or a different way, is really, and that was the conversation, frankly, at the tech conference. How do you price it? We're not fear that this is not going to be a piece of what technology will be going forward. The fear is, what does it cost and how are you going to pay for it, and what does that look like for multiples? That was the conversation this week.
And what's the answer?
Well, I think it depends. I mean, I think for the people with pricing power and the people who are embedded deeply, like we mentioned Salesforce, like I mentioned certain companies, I would bet on Anil Boozary at Workday that they will figure out what that means and how they will use AI as a tailwind versus a fear factor. And that is what is going to happen at these companies. Bill McDermott bought stock this week. You should have heard him fired up at our conference. I think he's very confident that they will be a winner. But watching this happen and watching some of the collateral damage will also take place. There will be companies that will not be around. I go way back to Sybase, Oracle, and Informix. Nobody talks about Sybase and Informix anymore, and watching what Larry Ellison has with Oracle is fun to watch. Same thing with Workday. We don't really talk about PeopleSoft anymore, but watch what Anil Boozary did and Dave Duffield did with Workday is astounding. You will see that again here. And I think that is the question mark for the next few years. The winners will be that much bigger. The adoption curve is that much faster. But I am not fearful that this software industry is dead.
Wow. PeopleSoft. I don't think we've had a PeopleSoft reference on our air in some time, Mark. Yeah, and you're right. ServiceNow is up 22% in about 4 weeks. I do want to get you on the IPO calendar and whether or not you think it's thinning or whether it's in danger of thinning relative to expectations at the beginning of the year.
Yeah, it's a good question. I mean, our backlog is strong here, Carl, at Citizens. I think the width of that backlog has grown, so it's not just tech and it's not just cyber or it's just AI. So I think that's the question mark. There is a little bit of a pause. The last few IPOs in technology have not performed well in the aftermarket, although the companies have executed. I think there is a rapid ascent for that IPO market if they see a couple winners. And I think they see a couple people, but there are people waiting for the biggies. There are people waiting to see one of the big five go public this year. I think that will happen. I think the IPO window is alive and well. Pricing is more important than the fact that we don't have enough quality companies. We do.
So your advice is to buy on the dips?
My advice is buy on the dip.
That's
be
what
patient.
you guys are doing?
Be long term. That's what we're doing. Be patient, be long term, bet the best, bet the whole. I can't say it enough. Anil Boozary coming back to Workday is a statement, a loud statement that he wants to be in the game for the next few years as AI revolutionizes every part of this economy, including his.
Mark, good stuff. Good insight, especially given where you are and what you've seen lately. Mark Lehman over at Citizens. Thanks so much.
Thank you.
Fed Governor Stephen Miron is with us next. His reaction to this morning's jobs report, whether he once again plans to push for lower interest rates than the rest of the committee at this month's meeting. That's coming up in just a few minutes.
Plus, watching the financials, today's worst performing sector, the KBE, getting hit a bit today. Although, as we said earlier, we are off the session lows. Dow's down 580. Let's get a CNBC News update with Leslie Picker. Morning, Leslie.
Good morning, Carl. The Department of Justice has released additional Jeffrey Epstein files that include uncorroborated accusations of sexual abuse by a woman against President Trump. Press Secretary Caroline Leavitt called the allegations baseless and backed by zero credible evidence. The president has consistently denied any wrongdoing in connection with Epstein. The Senate late yesterday passed a bill known as COPA 2.0, or the Children and Teens Online Privacy Protection Act. It aims to create new safeguards for kids online, such as blocking platforms from collecting their personal data without permission. The bill faces an uncertain future in the House. And investigators are looking for leads in the search for Nancy Guthrie, fanning out across her Tucson neighborhood Thursday, asking residents if they had any internet disruptions the night of her appearance. That's according to NBC News. There has been speculation that the suspect seen in the door cam video may have had a Wi-Fi jammer on him. The FBI and Sheriff's Department have yet to comment. I'll send it back to you, Sarah.
Oh, so sad.
So
Sad.
upsetting.
Thank you, Leslie. Thank you very much. Developing news here in Washington about those tariff refunds. Eamon Javers with the story. Is that happening, Eamon?
Well, we're not sure if it's happening, Sarah. We've got a new filing here from Customs and Border Protection in the Court of International Trade. And what the Bureau is saying here is that if they can't comply with the judge's order to move forward with these refunds, and the reason is technical. They have a system which they call ACE, which handles what they call the liquidation of the tariffs from previous years. Remember, you kind of pay an estimated tariff, and then they liquidate the tariff and tell you what you actually owe at some point down the line. That process, Customs is telling the court, is overwhelmed now with people requesting refunds, and they don't have the capacity to adjudicate all of that with the existing software and manpower that they have. And so what Customs is saying to the court here is they would like to have an additional 45-day period to try to get a new process up and running. So effectively, they're saying, we're trying to comply, but we can't for bureaucratic and technical reasons, and we're going to need some kind of a delay here. So TBD on when those refunds might actually get paid out, but the short answer is certainly not today.
Yeah, Eamon, I mean, no one's arguing that it's easy, but they did tell the courts that refunds would be automatic and assured, and that's how they avoided emergency relief.
Yeah, that's right. Now it turns out that it's a little bit less automatic and a little bit less assured than they may have thought because of this. What they're citing in this filing, Carl, is this ACE system that they use to actually what they call liquidate the tariffs. And they're saying that this system is overwhelmed. They need more manpower. They need more edits to the software to really make this work. So as a non-trade lawyer, be careful to say that, it looks like this is going to be a while before any checks actually start rolling out the door.
Yeah, well, it was messy when the Supreme Court didn't put any word on what would happen with the refunds. I think it would always be kind of a mess, legal mess. Thank you, Eamon.
You bet.
Eamon Javers. Up next, Fed Governor Stephen Miron's first reaction to the jobs report, whether it changes the outlook for the Fed rate decision that's coming up in a couple weeks. Myron consistently dissenting at the recent meetings. He's going to join us on the other side of the break. And watching the intraday market action here, stocks are trying to make a little bit of a comeback once again. It's a pattern we've seen all week, though we are still lower. Energy is leading the charge here with that spike in oil prices. And looks like consumer staples are holding up the best as well. Some of the cyclical groups, financials, materials, consumer discretionary, industrials, those are getting hardest hit. We'll be right back. Welcome back to Money Movers. Non-farm payrolls unexpectedly shrinking in February, according to new data out this morning from the government. This, of course, as the Iran war clouds the rate outlook for the Fed, which is set to vote on the next rate decision later this month, week after next. Joining us here at Post 9 is Fed Governor Stephen Miron. Governor Miron, welcome back. It's good to have you.
Hi, thanks for having me back.
Does today's jobs report change anything?
Look, I'm always hesitant to read too much into any single jobs report. I'm hesitant to read too much into this one, just like I was hesitant to read too much into the last one. But I look at the 6-month moving average of job creation, and I think, what are we even doing here? I mean, we're chasing phantom inflation of portfolio management fees, which are contributing 0.4% to core inflation, with job prints doing what they've been doing. I think policy is pretty miscalibrated right here.
You think that policy should be addressing the weakness in the labor market?
I think the labor market could use some more support from monetary policy. And
a lot of people think it's just lack of immigration and it's a supply problem, which is why we're not seeing job growth.
So if that were the case, if it were negative supply shocks like immigration driving the jobs numbers, I would expect to see the Americans who are the closest substitutes for immigrants having very, very hot, the hottest job markets. Instead, you see pockets of slack in the labor market are in younger folks and folks without college degrees. And that to me tells me that it's labor demand, not labor supply, meaning monetary policy is too tight.
Meaning what? Businesses are in worse shape than we think?
Meaning that they're not hiring enough. Not necessarily that they're in worse shape, but that labor demand is not strong enough because monetary policy is too tight. I think we're chasing this fake inflation of portfolio management fees that I've been talking about for months.
It's not just portfolio management fees. I mean, first of all, today, with Brent crude at $91 a barrel, there's an oil price shock.
No, it's not just portfolio management fees, but on a backward-looking basis, that's about 0.4% of core inflation on an annual basis. And yes, oil prices have moved higher. We have to see what happens. But typically, the Federal Reserve doesn't respond to higher oil prices like that. It boosts headline inflation, but it tends to be a one-off shock. And when you think about core inflation, it tends to be more predictive of where inflation's going over the medium term than headline inflation. And if anything, it slightly weighs on core inflation because it pulls demand out of the economy as people have to spend more on energy products. And so if anything, I'm hesitant to react to what's going on in oil until we know more. But if anything, it biases me toward even more dovish policy. I think that's the standard Federal Reserve reaction function.
We had a discussion this morning about whether this jobs print is giving us incremental clues about displacement through technology, right? Did you see any of that? And if you did, can policy help?
So, again, I'm hesitant to draw too much inference from any single print. I do think you see some of that in the data over recent months, and it relates to entry-level positions, like I was discussing a few moments ago. It's the folks who are entering the job market for the first time that are bearing the brunt of that. And to me, that's in a very standard, classic textbook way, exactly the type of unemployment that the central bank is equipped to help accommodate with looser monetary policy. Technology destroys jobs, but it always creates new jobs too. And that sectoral reallocation from the old jobs to the new jobs is something that monetary policy can accommodate. And that's a very classic.
I guess the debate now is about what is the new job if AI is trying to replicate cognitive work in all kinds of areas, right?
Yeah, so I think that people are really bad at imagining what those are ex ante, and that's always been the case throughout the hundreds of thousands of years of technological progress. For humans, even and before humans too, as as earlier types of Homo, Homos, just started using tools, right? Yes. We have a hard time imagining what the new jobs can be because they don't exist yet. And as an economist, I'm not really good as a futurist. I'm not really good at imagining exactly what the new types of jobs will be, but we have thousands of years of technological progress that indicates that we always create new jobs.
It does feel like more people at the Fed are more worried about inflation than you are, right? That's a fair statement, right? And there are signs. I mean, you mentioned the PPI. What with recent hot reports?
Sure.
We're not as bad as we were in the last few years, but we're not making progress anymore on the inflation front. And it isn't just the portfolio management. It's some of the services components. It's auto insurance. It's electricity costs. I mean, these have all been weighing on inflation or driving it higher.
So it's not just the portfolio management fees. I've tried to bring a lot of attention to housing as well. Market rents have been growing at a 1% rate for a couple of years now, despite the inflation data being indicative of what happened 3 or 4 years ago because of the very weird way in which these data are constructed. But the bottom line is there's no rental pressure, no price pressures in rents right now, and so there's no inflation pressure in housing markets as things are right now. Services, sort of core services, core market services are running below where they were, slightly below, a hair below where they were in previous periods when inflation was at the Fed's 2% target. So it's the non-market services like portfolio management that are the problem in core services.
What about tariffs? Have we seen the bulk of the effect on inflation yet?
So I've never had the view.
I know you don't think it's happening.
But if tariffs are driving inflation, imported core goods would be inflating more aggressively than overall core goods, and we just do not see that in the data. And so I've never been of the view that tariffs were a material driver of inflation. Now, tariffs can drive relative price changes. They can drive this or that category to go up, but on an overall aggregate basis, I've never seen it. On some of the categories that have driven it up, I think one example may be apparel. And I was talking to one of the nation's largest apparel retailers a few days ago, and what they told me was they pushed through all of their specific price increases in Q3 and Q4 of last year. And now not only are they done with pushing that through, so their price increases are going to flat, but they expect that in the second half of this year they'll be able to push some of those price increases back onto their international suppliers, which means they'll be able to start bringing prices down. Now this is a case in which the price increase, not only is the price increase transitory, not only is the price increase a one-off boost, meaning that inflation is transitory, but the price increase itself is transitory, followed by a price decrease if they manage to push that cost back onto their suppliers. That would be not only inflation being temporarily high, but inflation followed by subsequent deflation. This is a possibility I drew attention to in an inflation speech I gave in December at Columbia.
Just because of the demand destruction over time, or what?
No, because over time you can reconfigure supply chains or threaten to reconfigure supply chains and force that cost back onto the supplier. Now you can't do that overnight in all cases, right? These supply chains took years to build up, and it can take some time to actually push the cost back onto your supplier. But in the fullness of time, you should be able to do that.
Right. Does the conflict in the Middle East complicate that view? Any kind of reparation of supply chain?
That's sort of energy specific. So
a lot goes through the strait. Yeah. I'm just wondering whether you are worried about the conflict creating scarcity in all kinds of areas.
So if you have a long and sustained increase in energy prices that leads to more costly goods production, you may run into those types of risks. But I think we have yet to sort of draw a conclusion that type of thing is happening. And the other thing that I think really separates what's going on now from what happened before COVID after COVID is the overall policy settings. After COVID, fiscal policy and monetary policy were about as accommodative as they have been in the history of the country. And so it was quite easy for an inflationary shock like energy to ripple through and have second, third round effects and be persistent. That's not the case right now.
Yeah, plus we had a lot of fresh stimulus at the time.
Well, that's exactly what I'm talking about. Right now, the deficit is going down, the supply side is being pushed out through deregulation, and monetary policy is modestly restrictive, not as accommodative as it's been in the history of the country. So the overall macroeconomic backdrop is very different, and so the transmission of an energy shock right now is also going to be very different.
I want to pick up on the modestly restrictive point because I think this is going to be a big debate at the next Fed meeting. One of your colleagues who's a voter this year, the Cleveland Fed president this week told the Times that she thinks, Beth Hammack, that we're at neutral. So that the Fed is at a policy rate that is not hurting the economy or helping the economy. I know you disagree with this.
Yeah, I disagree, and I don't see how you could look at the labor market data the last few months and think that policy is about neutral. I also think that underlying inflation is running much closer to our target and trending down, and so as a result, I find it challenging to believe that.
Where's neutral for you?
I think it's probably about 2.5, 2 3/4. That's I think
so
a real
you think
neutral.
You guys can cut another 4 times?
Yeah, and so that's what I think is appropriate is to start by getting to neutral and then reevaluate. And I think real neutral is probably about 0.5%, and then you throw on 2% on top of that for inflation to get to a nominal neutral rate of 2.5. But then, of course, we work in ranges because we have a corridor system, right? So 2.5 to 2 3/4 nominal.
So you're going to be dissenting again week after next, it sounds like.
I hope not, but that would be up to my colleagues. I hope that we vote to cut, but if we don't, I expect
the case to cut has gotten harder. given some of the inflation numbers, given the price of oil. I know you push back against all of that, but I think people at the Fed may be more worried. I mean, today we're using the stagflationary word. Jan Hatzius has told us that's the risk we're seeing right now.
Incremental, right?
Yeah.
Yeah, so look, there's no question that oil will pass through into headline inflation, but what it does to the labor market and what it does to core inflation are, in my mind, pretty dovish. And so I don't revise my expectations, my projections in a hawkish direction based on higher oil prices. I think it's appropriate to keep cutting.
Similarly, I know you probably don't want to comment on other central banks, but there is an environment of hikes in Australia and maybe in Europe this year. Does that weaken your argument at the table?
You know, one hypothesis I have is that before the pandemic, global inflation trends were driven by a bunch of highly correlated things across countries. And so things like demographics, technology, globalization were pushing inflation down globally, not just in America. And that led to highly correlated and synchronized inflation cycles and policy cycles. After the pandemic, that's no longer the case because countries have chosen different types of fiscal stimulus. Countries have chosen different types of immigration policy. Technology, AI, is hitting America differently than it's hitting other countries too. And also globalization is trending differently in different countries too, with revisions to trade policy. So one hypothesis of mine is that pre-COVID, we had highly synchronized inflation and policy cycles. Post-COVID, I think that synchronization is in the process of breaking down because all of the drivers of inflation are pushing in different directions across countries. So I think it's very difficult to take a big inference for America from what's happening in those other countries.
Interesting. So rate trajectories could splinter around the world.
Yeah, I mean, if you think that something like globalization or technology or demographics, immigration policy can drive inflation, and one country chooses a very restrictive immigration policy, another country chooses a very lax immigration policy, it's only natural to think that inflation and policy could trend in different directions too. Whereas pre-COVID, demographics and technology and globalization were much more correlated across countries.
So what is your next move? Since we last spoke to you, you stepped down from CEA, Council of Economic Advisors, because you were keeping good on the what you told the Senate.
Yeah.
Right. You're still at the Fed. You're going to be at this meeting. Are you going to be at the? Do you have any visibility into what that looks like from there?
I don't. Planning is a bit tough for me right now, but I will be at the meeting in a couple weeks, and after that I'll take it a day at a time.
I guess you stay as long until they need your seat for Kevin Warsh, unless they get another open seat somehow.
Yeah, until Chairman designate Warsh or someone else is confirmed into my seat, I'll continue to what we call holdover, which is typical for Federal Reserve governors when serving past the expiration of their term.
Do you think that Powell will stay on as governor after he leaves his chair?
I don't know. You'd have to ask him.
Well, I would, but if he would tell me. But it is interesting, the changing makeup of the Fed and what that's going to ultimately mean. Do you feel like, do you feel like you're still the most dovish, and that's going to be the case?
I don't know if I'm the most dovish. I think we'll have to wait and see what the projections look like in March. But I think it's probably undoubtable that I'm among them. Look, I think that we don't have an inflation problem, that the inflation excess is not entirely, but largely a function of measurement issues. I think that the labor market can use more accommodation from monetary policy, and I don't see having a modestly restrictive stance of monetary policy as opposed to a neutral stance as being appropriate. I think being close to neutral is appropriate.
And is the notion of an extended pause in itself dangerous, do you think? Is time of the essence that much?
I think that the longer we run policy to be too restrictive, the greater a risk we run that we see jobs prints like we did today.
I know you don't think we have an inflation problem, but WTI right now is up 10.5% at around $90 a barrel. Is there a level where you would think, this is going to have this is going to be a bigger inflationary problem for the economy?
So it's a question of, one, the amount of time it spends elevated. If it spikes up and then comes down, that doesn't really leave a lasting mark on the economy. If it stays elevated for a long period of time, and we haven't got there yet, then it's the type of thing you have to think about. But also, inflation expectations are critical for judging whether or not that spike is going to pass through into broader core inflation.
They've been moving up a little bit, haven't they?
a little bit, but they're still consistent with inflation running pretty much at our target. They're all, other than the sort of short-term 1-year inflation expectations, the 2, 3, 5, 10-year inflation expectations are all, in ranges they've been in the last several months. So there's nothing in inflation expectations thus far that tells me that we're in concern of that oil inflation bleeding into the broader indices.
Well, we always appreciate the time with you, Governor Myron, especially making your case right before you have to go on blackout period ahead of the Fed meeting. Thank you. It's good to see you.
Thanks for having me.
Stephen Myron, Fed Governor. My mom is FaceTiming me. She forgot which time our show is on.
Still ahead this morning, the new Anthropic labor market paper validating one of the hottest trades on the street right now. We'll explain it when Money Movers continues.
AI has made it so that there's lower hiring of people who are kind of new college graduates, but higher hiring for people who are like a little bit in because they're so much more productive. It's so much more valuable. And so firms at the moment are, not having with AI much of an effect on jobs one way or the other because there's some declines at the bottom and increases at the top. But the increases are way more important for GDP because those people are being incredibly productive and getting huge wage increases. And so it's a real positive.
There were some signs of possible AI displacement in the jobs number today, with information services shedding 11,000. But there may be a new indicator that can better track the labor market of AI as it happens. Our Deirdre Bosa has more on that in today's Tech Check. Hey, Dee.
Hey, good morning, Carl. Key as it happens. So Anthropic yesterday dropped a new labor study using its own data. This is actual usage from millions of Claude conversations to map which jobs AI is already displacing and which ones it's not yet touching. This displacement map, we're going to call it, lines up with where investors are already putting their money, and that is the halo trade. Heavy assets, low obsolescence. So capital is moving out of the knowledge economy stocks and into the physical economy. Goldman's Halo basket, it has outperformed capital light names by 25 percentage points since the start of the year. Now, Anthropic's data shows why. For computer programmers, 75% of their tasks already covered by AI. Customer service reps, 70%. Financial analysts, nearly 60%. On the other end is construction, agriculture, transportation, installation, and repair. Near zero penetration today. That is telling us that the physical economy is the last place that AI will reach. Take a look at this other chart from the study. The blue is what AI could theoretically do. The red is what it's actually doing today. So you've got office and admin, huge blue area, small red for now. Same with legal, sales, finance. That's the second wave, and it maps almost perfectly to where enterprise deals are actually landing. Salesforce, Intuit, DocuSign, Thomson Reuters are all doing deals with AI companies. Anthropic's data backs up part of what we heard from Hassett earlier on our air, and you guys just ran a soundbite, and that is that experienced workers in AI-exposed jobs, they are more productive. That is certainly showing up in the data. But here's the part he's not emphasizing. Hiring of 22 to 25-year-olds in those same jobs has dropped 14% since ChatGPT launched. So unemployment, it hasn't moved because companies aren't firing people, they're just not hiring the next ones. And that is great for GDP today, but that is a problem for the labor market tomorrow, and it won't show up in the payrolls numbers.
I mean, it raises so many questions, Deirdre. Number one is, from a policy perspective, what do you do about this if we are going to see this kind of shock? Does it demand some sort of fiscal response? I mean, it's not the typical interest rates that the Fed can deal with.
You know, I wish I had even the inkling of an answer to that question, but it is just such a huge unknown, and it's a huge topic here, Washington, on Main Street. You know, young people are just having a harder time finding jobs, and what this data from Anthropic shows us is essentially there's no stopping this, right? And then you look across the stock market at public companies, and they're all doing these deals. You get layoffs. Some of them are, you know, using AI as an excuse, but some of them are really real. You've got companies that are growing, that are profitable, that are laying off parts of their workforce, or, as the data shows, just not hiring young people. This is going to be a massive, massive question that policymakers are going to have to be grappling with in the years ahead. And, you know, just everything that I see, everyone that I talk to, there is no answer in how to slow this. What I do hear, what young people can do, I don't want to make this all doom and gloom, use these tools, get to know them. That is what I overwhelmingly hear.
Retrain.
Skill up so that you're valuable. Exactly.
Yeah. Even as we're talking, Dee, Schmidt of the Fed on the tape, labor market under structural, not cyclical strain. And the more it happens, the more it will drive public sentiment. Could it have implications on data center development or any of the AI CapEx build out?
Absolutely. And, you know, there's an argument here that says, okay, we've been through this before with the internet and even the Industrial Revolution, and the workforce always skills up. I don't know if it's that simple this time around. Yeah. You know, the AI leap is so different, I guess. You could, you know, it's as big as anything else, but there might be some gap period, right, where the labor market does really struggle before everyone can upskill. And we're seeing exactly where. It's amazing that Anthropic and some of the other labs are putting out this data, because it tells us exactly, based on the usage, like which sectors it's coming for now and where it's going.
But that is still up for debate. I mean, a lot of CEOs in the tech space disagree with the fact that it is just going to displace all of these jobs and not make them more productive and not make people hire more. So it's still a debate, and I don't think it's definitive what we're seeing in the data yet. Even in today's jobs report, you know, nothing glaring on that front. Thank you, Deirdre. We got CPI next week, GDP next week, and some earnings. Be another eventful one. We'll watch the headlines from Iran.
Rest up. Let's get to the judge.
Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner. Front and center this hour, sinking stocks, a huge jobs miss, another spike in oil, and it has caused some selling in the market yet again. We discuss and debate with the investment committee. Joining me for the hour today, Shannon Sakosha, Jim Lebenthal, Stephen Weiss, and Josh Brown. We will take you to the markets. We're weak, obviously, across the board, off the worst levels, but nonetheless, you do have almost 1% or more declines for everything, clearly, but the NASDAQ, which is about 0.75%. I mentioned what's really, Steve, driving the action today. The jobs miss, the oil, gas prices are up. Qatar warning that the war could shut down production from the region, drive oil to $150 a barrel. B of A says only persistent oil spikes really matter. The VIX at 28 earlier today. What's on your mind as we wrap up what's been a pretty turbulent and down week?
Yep. So look, this is a daily occurrence. We start out on the lows, the overnight futures really at the bottom, and then we get buyers, bargain hunters coming in or short covering. And I don't see that changing anytime soon, except for the fact that I have to believe the president is looking at this as he does. He pays attention to the market, pays attention to the polls, and saying, maybe we got to get out of here sooner. Now, oil and jobs are an issue, because even if when they shut in the oil, meaning production, because the silos, the tanks are filled, it takes a while to start it up. So you could see an extended inflationary bump. So the question then becomes, does the Fed look through it? And I don't know about that, except for the fact that the job numbers were so bad, they're going to have to look through it. But again, that's 1 month. We're basically zero over the last 2 months. So what I believe is this market's a lot different. I was thinking about the 1970s when you had the oil shock. Yep. At the same time, you had low presidential approval ratings and you had inflation. So we've got 3 of those elements in place. What's different now, though, is that the market's different. The investors in the market are different, and they look at these as opportunities, and I agree with that.
I mean, the situation's obviously a little different. We don't have an oil embargo. You don't have it to that extreme. Yeah. The president's approval ratings may be low, but you're not in the what at that period of time Jimmy Carter himself described as this malaise. Over the country. The economy's still in pretty good shape.
And I'm not suggesting that. I think that these are buying opportunities. The only question is which buying opportunity you take advantage of. If you did it 2 days ago, you'd say, wow, I could have bought cheaper today. If you did it yesterday, you'd say I could have bought cheaper today. So I think at some point people sit in their hands and say, hey, you know what? Let me wait for a bottom.
I mean, to play that one even step further, it's not like we necessarily have we don't have a crisis of confidence. None. To play again off of what the president back then was suggesting. The economy's pretty good. I mean, I know the jobs number was lousy, but there's a lot of noise within it. Let's wait a little bit. Strikes. Let's wait a little bit before we determine that all of a sudden this great economic picture that we thought we were painting is all of a sudden, watercolors and it's running off the page.
And I think that the transitory nature of what we typically see from an oil shock such as this, if you think about core versus headline inflation, we know that the Fed is generally looking for pass-through to services. And we'd have to have a very sustained period of time where oil prices are up near this level for us to see that eventual transmission. The challenge is if you go back over the course of the last several Fed meetings and you read through the minutes, there already was some expectation that perhaps the Fed was a little bit more concerned about inflation than they were telegraphing in those press conferences. So I don't think it's just the oil price movement here. I think it's the combination of oil price movement plus a weak jobs report, which in another environment, even taking away what's happening with oil, I think that you would see perhaps a rally because that would be an incentive for the Fed to act sooner. But again, just looking at the last few months, there's a lot of folks on the FOMC who are a bit more concerned about inflation than what they're coming out with in the press conferences. And so I think those are culminating and compounding to this movement in the long end of the curve, which is what I think we're seeing indicated in the equity markets, this concern about an unanchored 10-year. I think that's a real challenge.
The Fed was already on hold coming into this upcoming meeting by all accounts. So it's not like these events have all of a sudden forced a 180. Right? So, the market's going to sit back. It's had a rough week. It's going to watch oil probably more than anything else. Hard to make big bets over the weekend. Just don't know what's going to develop when you're at a time of conflict. How do you see it?
Well, start with where Steve was, that this has been a market that on an almost daily basis has rallied into the close. Unfortunately, I would be surprised if that happens today for the reasons you just mentioned, Scott. We're going into the weekend. We're going into 3 days. The markets are closed and anything can happen. Now, anything can happen on the positive side as well, but in what's going on right now, the market is, I think, likely to look at the final hours of trading and say, maybe it's time to take a little risk off, or at least not time to dive in just yet. The good news is, I do think this market pivots around one particular piece of news that we're waiting for, which is tankers flowing through, running through the Straits of Hormuz. I can't tell you when that's going to happen. I can't tell you how that's going to happen.
Do you think? Do you agree with? So you've got Qatar talking about 150 a barrel. Okay.
Yeah.
That obviously gets the market's temperature up. Whether that's likely or not, who knows?
Yeah.
And we can't judge that. It's not even worth opining on it. But when Bank of America says only persistent oil spikes really matter, can we say we agree with that?
We can definitely say we agree with that. And that's why everything we're talking about today is a temporary factor. I'm not sitting here and saying that long-term investors should start selling their stocks. There's no indication that we're going into a recession.
I mean, look at WTI now, right? Up 11% today. We were on the brink of 90. Now we're there.
Yeah. If I owned crude right now, if I were an oil trader, I'd be selling a third to a half of my position today, because any moment you could wake up and say, okay, we're pulling back.
And the same thing on treasuries. You should perhaps be extending duration in this environment because there is going to be a response.
So, Josh, what's on your mind as you've heard everybody on the panel here give their views, and you look at the markets in the manner in which you always do?
Yeah, I think I'm with Weiss on the oil price spike. Not really. It doesn't appear that the stock market has bought into that, and I'm just judging by the prices of the equities themselves. They are not acting as though this is a new oil price regime, because if they were, you'd see a lot more green in this area of the market. You're just really not seeing it. This is the highest oil is traded since September of 2023, and it's the biggest weekly jump since 2022. But that's what it is right now. It's a weekly jump. It's not more than that. It certainly could be. But I have 20 energy stocks on my list of best stocks in the market. And the median return for these names is 26% on a year-to-date basis. Year-to-date. It's an astounding return. These stocks are not following through on what we're seeing happen with WTI crude at the moment. But when you think about stocks like Texas Pacific Land, which is up 83% year-to-date, a lot of traders in that name. Valero up 40%. Baker Hughes up 33%. These stocks have been going up for a long time, and today they're barely doing anything. And for me, that's a powerful signal that tells me big institutional money is not buying in on $150 crude. I would also just point out, big picture, it is a Friday, and we are, whether Congress has declared it or not, at war. You have servicemen and women at risk. You have assets in the region. It's very unpredictable, obviously. And it's a live fire zone. So seeing a risk-off move on a Friday, knowing that we have this gap coming up of 2 days where anything can happen, it actually seems very orderly to me. It makes a lot of sense.
Yeah, so far, for sure. And we'll see how this final day of this week progresses. There's a lot of stuff on the radar. Jefferies today noting the 3-day momentum unwind. That was Tuesday to Thursday. The fourth worst 3-day stretch in the last 2.5 years for MTUM. If you look, it's down almost 4% over the past 3 days. There's some pretty popular names within this orbit, okay? Walmart down 3.5%. Some of the banks like JPM and Goldman Sachs, J&J and Micron and GE Aerospace and CAT. Lam Research leads the list to the downside, down 10.5%. Shan, what do we make of that slide in momentum? I guess it's not surprising when you have the moment of war impacting sentiment on the street.
Well, I think that's where you mentioned confidence earlier, Scott. This is where we're seeing a little bit of a decay in confidence is in these momentum names. But I think it's important, too. There's a couple of idiosyncratic or stock-specific stories that are working here in terms of bringing a couple of these stocks down on this list. But I think overarchingly, you're looking at an environment where we're now into kind of day 6. There is the potential that investors want to add a little bit more defense. And that defense is likely to come into some of the areas where you haven't seen momentum, where you potentially are seeing a bit of that value tilt, if you will.
You mean defensive names in the market?
Yeah, I think that you are seeing, you could see.
Because this has been a really tough week for that trade. Pull up a week of like Staples. pull up healthcare. Since I mentioned J&J being on the list, it's been a nowhere to hide other than maybe a couple of mega cap stocks you can, feel a little bit better.
So that's why I was just going to clarify. Not typical defensives, but I think some of the stocks that have been stores of value during previous periods of weakness in the stock market and momentum are seeing a bit of a bid. And I wouldn't be surprised necessarily to see some of the mega cap tech stocks, some of the stronger discretionary names actually start to get a bid as we go into next week, Scott, because I do feel like this is an opportunity to perhaps increase the quality of the portfolio. And some of these momentum names are just gotten too far ahead of themselves in this environment.
I feel like, Weiss, the most important stocks right now are the banks. Okay, I mentioned the unwind in momentum from the Goldman down 5% or JPM, which has been troubled, but I just can't imagine a scenario in which the banks keep going down and people feel better about where this market is.
Yeah, and what you're really doing damage to is to the IPO and banking case that was made for the banks, and so nobody's doing an IPO, right now until you get stability in the market.
Well, there's one, then we'll talk about that later, so save that for later.
There'll be one here and there, but basically, and then you've got private credit, which is also hitting the banks. So a lot of headwinds. Look, I think Goldman is, that's the one I own, pretty well positioned. I believe JP Morgan is always well positioned. The question is now how long you have to wait for the M&A trade and the IPO trade.
Well, I mean, it's beyond that. It's Jimmy. It's assessing where we think the economy's going
exactly.
to.
With that, exactly.
That
the IPO
probably supersedes the IPO activity.
Those are indications of
deal making.
Yeah. Well, look, I mean, we just got the Atlanta Fed GDP update today. It's now down to 2.1%. We have been talking about a growth scare in the economy for quite some time, and in the last quarter, fourth quarter, we were talking about it from the perspective of a government shutdown, which was temporary. We knew that was going to end. Now we've got some signals here that the cushions that are built into the economy, strong economic growth, good labor market, they're kind of getting a little wobbly here, and definitely that's impacting the financial sector, which is dependent and expecting a strong, robust economy going forward. I do want to make clear, I'm not giving up on the idea of a robust, strong economy. I think there's reasons to expect it. Whether it's profit growth, whether it's low weekly initial jobless claims, there's a lot of reasons to think that this economy is still going to power through. But I go back to where I was just a minute ago. You do, as temporary as the oil spike is, the longer it lasts, the more damage it will do to things like profit margins. That's where people in corporate seats get a little worried about, hey, are profits going to come down? Do we need to start laying people off? So solve the oil problem quickly.
I think anytime you invest, you say, what's my base case? And then where is it more likely to go wrong, to the downside or to the upside? So with the economy, base case, everybody's saying, we said it here, economy's doing pretty well.
Sure.
So where's it likely to go wrong? To me, to Jimmy's point that he was alluding to, it's more likely to go wrong to the downside. So, and that's my concern. I'm not doing anything about it, but that's my concern.
The private credit side, you guys were talking about that. BlackRock, we should look at that, and we should discuss, especially since we were just talking about the financials. They've limited redemptions at a private credit fund. So it's the worst day since April for BlackRock. You can see that's the lows of the day, down more than 6%. You own the stock.
Yeah, we should expect this type of news to continue. And I think we've alluded to that over the last couple of weeks, that there have been some good news like Blackstone allowing some of its redemptions to be above the 5% gate. But there's no question that investors are now thinking, hey, I want to take my money out now while I can. So we should expect the next few quarters that there are redemption requests in excess of the limits. Generally, they're 5% per quarter limits. Now, there is a playbook for this. It's not a pleasant playbook, but it works out all right, and that's Blackstone with its B-REIT from about 3 years ago, and it took about 2-3 quarters to work its way through. B-REIT is on stable footing right now, generating good returns. There's nothing, by the way, in this news that speaks to corporate credit. It just speaks to what we were talking about, that investors are likely to pull money out, and the gates will be put up.
The other note I wanted to hit, Josh, I'll start with you on that, is from Bank of America's Michael Hartnett, who always is really thoughtful in how he assesses what's happened in a week inside the markets, in which he says his top observation today is the week has shown the fragility of investor conviction in value and small cap and international stocks versus U.S. growth. He's calling that a mini exodus. The things to watch next, he points out, recent leadership. Okay, the EEM, the semiconductor index, the banks, as we just talked about, and the idea that a further breakdown, and then you start talking about canaries in the coal mine for broader market pain. And it really matches what Jonathan Krinsky told us just the other day on Closing Bell. You cannot lose the semis. This market has already gone through the turbulence of the software trade, which may be getting a little bit of a bounce. Now, who knows if it's sustainable, but you cannot lose the semis, which are on pace now for the worst week since November.
Okay, I don't think Krinsky is wrong that we want the semis to be strong, and I agree with Hartnett that a lot of things people just started buying because they were going up, and then you hit some headline risk, and all of a sudden you see, all right, the accumulation beneath the surface is not as strong as we want it. And the third thing I would say on the bearish side, like, nobody should be celebrating a rally that's led by the utilities, but that's where we are. Okay, fine. I take all of that. But I think days like today and most of what we saw this week is counter trend. The IGV is now up 8% from the Citrini disaster. So was that the bottom? I'm not so sure. I think we're seeing a rally in a lot of these software stocks, and I'm happy because I did some bottom fishing in my software names. But I think it's counter trend. And I think a lot of the sell-offs that you're seeing today are also counter trend. And the bigger trend is not what today's tape looks like, software strong and all these other areas being weak. I think it's the reverse. So I'm willing to take the other side of that, and I'm willing to say, okay, every once in a while in a bull market for the S&P 493, you're going to see these kinds of pullbacks. But the level of participation that we've seen this year and the level of dispersion and the level of people being willing to look at stocks they haven't looked at in 5 or 10 years, I still think that that's the prevailing trend. And so if I had to bet one way or the other, I would not take the bet, yeah, we're in a new environment. Now you want to be long software, short semis. I really don't think so. I would just say don't get gassed by these sort of counter trend bull and bear markets that are not the real story.
Yeah, well, that's a big story right there. The chips down 4%, as we were just talking about. And the idea, according to Krinsky, that these are just too big to fail. They matter too much, especially to where we are from an AI perspective. These stocks are now among the largest in the market. I obviously don't have to tell you that NVIDIA ranks at that degree, but there's Broadcom and some of these other names as well. A lot of the memory stocks, which have gone, crazy to the upside.
And needed to have a little air let out of them. I think we can admit that if we look at the chart of Micron. It needed to come down a little bit. It might have just been looking for an excuse. But I'm glad you went here, Scott, because, I talked a minute ago about cushions in the economy. And despite all the terrible news we've had this week, I don't think, Microsoft or Alphabet are going to interrupt their plans to keep building out data centers. I don't think OpenAI, which has just raised whatever it is, $100 billion, is now going to say, oh, I'm going to stop. And these things are, to a certain extent, insulated from what's going on in the Middle East. The reason I say to a certain extent is, yes, there will be some inflationary pressures, but as we've all said, those inflationary pressures should be temporary. So this is a major cushion to the economy right now, the capital expenditures on data centers. It's impossible to believe that, like, on Monday, they're going to start pulling back.
I'm not sure the inflationary pressures, all of them are temporary. With oil, I believe they are, but with tariffs, the estimates are they go through the end of the year with the new tariffs. So that's not temporary.
Yeah, but you would agree it's a one-time adjustment, right?
I agree. I agree with that.
The reason the chips, would be under pressure the way they are, not like a direct result of anything other than looking for an excuse.
Exactly.
Take some profits
to be hit because the stocks had gone up so much. It's not like the war is going to impact the chips or other things that are necessarily happening.
Agreed.
Certainly some of the commentary out of the administration regarding, sales of compute overseas doesn't help.
Right.
But these stocks, some would suggest, were ripe for going lower. They just needed the tipping point.
What epitomizes your point is if you take a look at FTAI, if you take a look at Bloom Energy, those stocks were up significantly. and they're getting hit all week. But relative to where they were, they're still up so much over the last year. But the question then is, are people going to be more, anchored in valuation for a period of time because they're overvalued?
I think part of the point here too is that the market will be just fine.
Yeah.
You can quote unquote lose the semis for a minute, so to speak, if you have software show some life. To counteract that, you can't have both unravel at the same period of time. By the way, software versus semis, let's show it again. Oh, yeah, good. Thank you, guys. Yeah. The widest 8-day move ever in that spread, right? It had looked the opposite for at least the last year, I feel like, when we've been talking about it. Yeah, Josh, go ahead real quick. Yep.
They said we couldn't lose the hyperscalers. We needed the Mag 7. Those stocks topped in October. I know it feels like, it was just the fall. That's 6 months ago. Those stocks topped 6 months ago. Think about how much money has been made in all of these other areas. Think about how many large caps are up 5 or 10% year to date already. We lost those stocks. It's honestly not the way the modern market works. These rotations are powerful.
I agree. Remember the conversation before that? You can't lose Apple. Apple's the engine in the market.
Yeah, but I mean, come on, the semis are a huge group. You can't lose the semis at the same time you're losing software. I mean, I think the market, the impact of that.
That's where the money goes.
But isn't what's happening in the Middle East, like for many investors who are looking at fundamentally some things that have been perhaps oversold in this environment, wouldn't you look at software? Because again, to your point, Judge, you're making a completely accurate point. The opportunities for software, AI obsolescence is now in the background of this narrative. And so if I'm looking at companies I've wanted to own for a while and I was waiting for perhaps that point at which I feel comfortable buying into them, some of these software companies are hitting that point now and they're away from the Middle East.
Do we feel better about every day? Okay, Microsoft. Do we feel better about software? I know it's had a nice little move. You're going to have tests next week. Oracle's next week. Adobe is next week. We've had the best week for the IGV since April of 25. So you've got that. Cyber's had a big week.
So here's the answer to your multifaceted question. We have already seen that earnings reports have not helped these stocks very much. I mean, maybe a little bit. Maybe we can say that Workday's earnings, Salesforce earnings last week maybe triggered this rally, but there are still substantial questions out there. The one things that I'm looking for in these reports from like an Adobe is what are they doing with their cash? In Adobe's case, I want them buying back shares. In Oracle's case, I want lucid plans on how they are raising funds to fund all of these data center builds out. But these are the questions that need to be answered. And unfortunately, as much as I believe in those two names, I think it's going to take many months before the bottom is really called. I'm almost done. What you may be seeing here this week and last week is just short covering. I mean, it got to a point where the shorts said, hey, we beat these things into the ground enough. Let's take our profits.
Yeah, I don't feel like there's a lot of conviction to be
agree. And so
sat on at this point.
I think it's what's happening for people that have to be in the market, that benchmark against the market. They say, okay, where can I go high in an area that's been decimated already where my downside's minimal? You're not going to hide in FTAI, right? You're not going to hide in Caterpillar.
You go high.
Right. Yeah, exactly. So you go hide in software. So at best, it's a tradable low. But from a long-term standpoint, I don't see them coming back with AI.
Let's get one more thought on a group of stocks before we take our first break. It's airlines. Not surprisingly, worst week since April of 25, okay? For a variety of reasons, not the least of which jet fuel prices are surging, okay?
Yep.
That doesn't reverse itself right away. Now, you have the exposure to Delta, but if you look on the week, there's the Jets ETF, which reflects the broad space, but Delta's down 6.5%, American and United down 10% each, Southwest down 11%, JetBlue down 17.5% this week alone.
Yeah, and they are responding as they should to the news that's out there. Here's my experience with Delta, is emblematic of the airlines. I've been in it probably about 3 years now, and every time there is a scare, it goes down as it should. What sort of scare? I mean, they're always different, but remember Doge, and we're going to have, no federal travel, or, remember we had the yen carry unwind, and then the SOM rule, and unemployment was going to spike higher. All of these things happen. The stocks respond to the downside. And then when this clears, which I do think it's a question of when, not if, the Middle East will clear, the stocks resume their height. And the key thing here is that the U.S. economy has to stay out of recession. Nobody's calling for a recession, and I'm not.
Hey, why aren't you buying more Delta down 10% on the week if you're so bullish on this space?
You know what? That's a good question. It's a really
question.
good question. And the answer goes back to where I started. I have new money coming in all the time, right? As a firm, we're always getting new money in. Am I trying to be a hero today on a Friday with a shooting war in the Middle East and the Straits of Hormuz closed? Or am I going to wait until Monday and see what 3 days worth of news cycles goes through? I am emblematic of the markets in that response. I don't need to be a hero today and step into this. I don't know what's going to happen over the weekend. If I end up that over the weekend, the Straits of Hormuz opens, oil comes down, these stocks rally 5%, I'll have plenty of time. But I'm not being a hero today.
A trade here. I'm not in it. But most of the freight that goes around the world is carried on commercial planes. And with the commercial planes not flying through the Middle East, et cetera, you know who benefits? FedEx. So FedEx's volumes go up dramatically during this period of time. So I imagine next quarter their report is going to show a nice bump in earnings.
It's been a rough week for FedEx and UPS, obviously.
Economic concerns, I believe.
Yeah. All right, let's do this. Let's take a break. We do have a new committee move that Steve Weiss is going to tell you about, and many, many other stocks to discuss. We'll do that. Josh Brown's best stocks in the market coming up as well. All right, we're back. Chinese tech names have been lower lately as well. Alibaba is down 8.5% this week. Mr. Weiss, you bought more. Now, why are you doing that?
I did. I got into Alibaba somewhere in the 150s, and it looked good for a while, but then it's gotten smoked, as you point out, this week. And the reason why I did it is it's cheap. Keep in mind, Chinese companies are on a March fiscal year, and once we roll this year, you're looking at a PE of about 18 times. That's very cheap. On an EBITDA multiple, it's 10 times. So to me, those are good stories, and they've got some of the same tailwinds as we see here with the hyperscalers, which are cloud, which are AI, et cetera. And you're seeing narrowing losses in e-commerce. So I think it's you know, I think the fundamentals are very much intact, and the reason that I bought it, except I'm getting a lot cheaper. So this is one where I do go value hunting.
Would you own any of the other names?
I don't really look at the other
in that
names.
universe?
I'm not big on China overall. This sort of, I like the idiosyncratic risks here. I just haven't done the work on them. But Bob is not moving and leaving the others behind, for sure. It's a question of which of those you want to play.
Okay. Josh, let's get to you on some calls. Shake Shack initiated buy today. 125 is the target at D.A. Davidson. What do we think?
Yeah, look, I think that this is a story of a boutique sort of, I don't want to call it luxury, but sort of a very high-end version of what it is. Finally get.
All right, team, I'm going to go ahead and end it here. The market's not doing anything. We'll try again next week. Be well.